Hi, good evening, everyone. I probably don't need to use a mic. Very good afternoon to you all. Not sure if everyone has got over the North Star and GITEX hangover, the traffic jams, and hi, come in, come in. I'm Cicely George, the Executive Director of TIE Dubai, and it's my absolute pleasure to welcome each of you today. And before the session starts, I'll do a very little introduction on what TIE Dubai is about, especially to the ones who are not that familiar. And we do hope that today's session is going to be valuable for each of you. Keep it interactive because we've kept the length of the session so long so that you're able to address specific queries. Since it's a new thing for everybody, there's going to be a lot of questions and answers that needs to be sought through this. So we've kept it long to keep it interactive, and do share your questions. Pankaj is excellent to help you navigate through your individual scenarios. So we've given ample time to go over all the secrets of getting your tax sleep, why we should not fear penalties. That was a curious one that caught my eye. We will cover individual queries and also speak to founders and investors to understand the different dynamics and role that plays, when corporate tax specifically for startups and founders. A little about TIE Dubai. In a nutshell, TIE is an organization that fosters entrepreneurship globally. What started as a conversation, a small gathering in Silicon Valley in 1992, has turned into more than 60 chapters in more than 14 countries. So how TIE functions is mainly on 5 pillars: mentoring, networking, education, funding, and incubation. While TIE has a global reach, we actually focus a lot on the local ecosystem to make sure that the programs are relevant for the region. There are some great programs that we run. I'll just very quickly run you through it. We have a TIE mentorship program, extremely beneficial for companies that are looking for support from seasoned and successful entrepreneurs who will help you navigate your startup journey better. These run in cohorts, and you should keep your eyes open on our social channels whenever that opens. It's a great one where you have somebody who's very well versed and have done that probably several times to help you navigate your journey better. There's also the TIE Women MENA program that we've just finished wrapping up its regional leg, where we had 5 separate competitions. We had a focused one this year for Emirati women entrepreneurs. We also work with women entrepreneurs from Egypt, Saudi, UAE, and rest of the Middle East. Some amazing ideas that come through. We had a TIE Women MENA finals at North Star this year. 2 startups walked away with 100,000 dirhams as equity-free prize money. And they still go on to pitch in Singapore for the TIE Global Finals, where they get to interact and mingle with over 40 women entrepreneurs coming in from all over the globe. There's $50,000 equity-free prize money again there. So as we also work with universities. There's a university program that's going to launch for next year soon, where we work with idea level startups and help them navigate and become projects and businesses. So we've had startups, winners raise $50,000 over a year of, moving from 20-year-old, moving from college to business and things like that. Great stories. So basically, if you follow TIE Dubai on any of the social channels, LinkedIn, Instagram, YouTube, we have a lot of sessions on YouTube that are out there, which could be valuable for you. So these are the, just look for TIE Dubai, Twitter, Facebook, everywhere we are TIE Dubai. A very special thank you to all our charter members who make all the amazing happen. We have a board that really runs all the programs of the chapter. And moving on to today's panel, I'm more than pleased to introduce you to our speaker for today, TIE Dubai's tax advisor and a friend, Pankaj S. Jain. Pankaj is the founder and managing director of Ask Pankaj Tax Advisors. With over 2 decades of extensive experience, Pankaj specializes in the entire gamut of taxation, including VAT, corporate tax, and tax management. He has advised multiple MNCs on taxation, compliance, business model structuring, and tax implementation. Pankaj leads the Ask Pankaj Tax Advisors team in advising UAE companies on tax regulations and compliances and deals with organizations of various sizes. Pankaj has previously held senior roles such as National Head Taxation at Coca-Cola India and Tax Head for Cola India, and also worked extensively on advisory on UK European VAT with KPMG Belfast. His other tenures also include working with Deloitte, PwC, and Lakshmi Kumaran and Sridharan. Pankaj is a chartered accountant with an All India 29th merit position and a chartered tax advisor. Pankaj, I leave the floor to you to take us through the nuances of corporate tax and all the tax sleep we all need in it.
Thank you. Thank you. Hi, good afternoon. Thank you for joining us today. Without mic is audible?
No, the YouTube needs your mic.
Okay, thank you. Thank you for the generous introduction. Perfect. So, just starting with a quick point, how many of us here are afraid of tax? Okay. And how many of us are afraid of UAE tax? See, there are different answers because apparently the penalties and the experience of penalties in the VAT regime, which was introduced from 1st of January 2018, has been kind of a bittersweet pill for many of them. True. Let me start by saying that when it comes to corporate tax, and as we will discuss during the session, the chances of you being penalized for the next 1 year is almost nil, because there is no immediate compliance that you need to do, for which if you fail and there is a penalty. As much as the registration for corporate tax, there is no deadline per se that you need to register by today or by 31st of December. So there is no deadline prescribed, and accordingly there is no penalty. Of course, it's recommended to register for corporate tax as soon as possible, but again, there is no timelines on this. The second, I'm just giving a brief background, then we'll come on the sessions. Unlike VAT, which was implemented in 2018, which is a transaction-based tax, and the transaction which is happening in real time, like today you supply goods or services, you need to make sure that your transaction is compliant with VAT today. When it comes to corporate tax is payable on the profits that you would earn during your taxable period, which is your financial year. So your financial year, if it is Jan to December, has not yet even started. Once it starts from Jan 2024, ends in December 2024, you calculate your entire year profits, do certain adjustments that we will discuss, and then calculate your corporate tax payable. So there is nothing that you need to do on a daily basis to make sure that you are compliant with corporate tax law. So long as your accounting is correct, so long as your record keeping is correct, you don't have anything to worry immediately. With this, starting on the corporate tax, just giving you a kind of a brief view of corporate tax, how it's happening. There are two authorities, so to say, which is working on the corporate tax. One is the Ministry of Finance. The Ministry of Finance is coming with federal decree law, and then it's coordinating for various cabinet decisions, various ministerial decisions. And then the second authority, as we all know, is the Federal Tax Authority, FTA. We all have interacted with FTA for VAT purposes. FTA is the authority to administer the corporate tax. So we have a lot of frequently asked questions, a lot of guidance, a lot of awareness sessions being conducted by Ministry of Finance. And then we have such guides, public clarifications, and other awareness sessions being introduced by the federal tax authorities. So please keep in mind that both these authorities will have a bearing in terms of what they have clarified, what they are proposing, and how the law will evolve. This is an interesting aspect because corporate tax is new to the UAE. As we always say, taxation is not new to the world. It may be new to the country. So there is already an established principle, established issues and everything. So if we look at the frequently asked questions or the guidance which has been issued by the Ministry of Finance ever since corporate tax was announced, the first time the FAQs were announced, there were only about 157 FAQs which were there. Then there was a revision which happened, and the number of questions which were answered or number of guidance which was issued increased to 209. And very recently, they have updated the FAQ once again, and now there are 353 questions which has been answered by the Ministry of Finance, and it's available on the Ministry of Finance website. The point that I'm trying to bring home is that tax here in UAE is evolving. More and more the tax authorities are getting to know the practical issues, the business challenges and everything. They are responding to it in terms of guidance through the FAQs and everything. In addition to this, Ministry of Finance and FT have also conducted numerous in-person and virtual awareness sessions. If you are not aware of it, our sincere recommendation is just start following their LinkedIn page, Ministry of Finance and Federal Tax Authorities. They keep announcing a lot of virtual sessions on the taxation, which was very helpful because it's not repetitive in nature. In every sessions, you'll get to learn something new, and which is the evolving positions on it. Now with this, I come on the technical discussions. So how we have divided the sessions and everything is, as Cicely has mentioned, we want to make it as interactive as possible, so you can feel free to ask questions. This is not a one-way traffic that I come and I speak. It is, first I'll cover the technical bits, which is again subdivided into sessions. Then you can have a specific Q&A in addition to the interactive that you can ask right now. And then we have towards the end a panel discussion where as founders, as investors, what are the typical issues on taxations that people have? And we can try to answer and address those queries. Now, when it comes to corporate tax, the first image everybody has is it's a corporate tax. So it's a tax applicable only on companies. However, actually, if you read the title of the decree law, it says taxation on profits of business. So if an individual is conducting a business, an individual could also be subject to corporate tax. Now, what are the situations in which individual could be subject to corporate tax? And what are the situations in which individual would not be subject to corporate tax? There are three categories of income which has been prescribed, which would not be subject to corporate tax at all. The first category is personal investment income. So when we talk about startups, when we talk about the Thai environment, if we are the investors, as individual, I'm investing in a startup and I'm contributing to the capital, then in my individual capacity, whatever I'm investing, and then I'm earning whether a dividend or a capital gain when I'm exiting a startup, all such income would be outside the purview of corporate tax. Similarly, if I have bank deposits, if I'm as a normal investor, as a share investor, if I'm investing in shares and I'm earning dividend, I'm earning bank interest, all such incomes in the hands of the individual is not subject to corporate tax. The second category, which is quite important in the UAE context, is the real estate income. So an individual investing in real estate, whether it's residential real estate or a commercial real estate, whether the individual is earning the lease rental, whether the individual is earning the gain on the sale purchase of the real estate properties, all such income in the hands of the individual would not be subject to corporate tax. Now, here we will come, when we come on the company taxation, what we have observed historically in the UAE concept, that a lot of companies wants to take finance facilities from the banks. So what do? Even though the real estate otherwise belongs to the individual, but the real estate is actually purchased in the name of the company. Because the real estate has been purchased in the name of the company, even though I'm the 100% owner of that company, since company is the owner of that real estate, then this exemption will not apply. So the company earning any real estate income, whether on account of lease rentals or the profits on the sale of that real estate, would be subject to corporate tax. And the third category, and which is the most curious one, which we will discuss in details, is the individual earning wages and salaries is not subject to corporate tax. So these are the three categories of income which are not subject to corporate tax. Barring these three categories, if an individual is earning more than $1 million dirhams from any business or a business activity conducted by that individual, so we have typically a freelancer's visa. You may be as individual earning some sort of a referral commission. We will come on a situation, you may be earning a director's fee as a position of directors in various companies if you are earning a directorship fee. And that income is exceeding $1 million dirhams per year, then as individual, you need to comply with the corporate tax law in terms of corporate tax registration and submitting the corporate tax return. This is as individual total. So as individual, it's not per entity I'm earning more than $1 million dirham or not. As individual, what is my income from business or business activity, excluding the above three categories? Suppose I'll give couple of examples. I have a portfolio of investment, real estates, both residential and commercial, and I'm earning the lease rental income from this. And the total lease rental that I'm earning from this portfolio of real estate investment is, say, 10 million dirhams. I am not subject to corporate tax as individual. We are not talking about setting up a company here. I'm talking about in my individual name, I have a portfolio of a real estate investment. Irrespective of that income from real estate, I don't have to pay any corporate tax. Even though if the fact that I'm maintaining a portfolio of real estate and everything means effectively that I'm doing a business. But by way of a policy, they have excluded it from the corporate tax. That's not allowed. So on the wages and salary, I said it's a very, very peculiar case. So because lot of individuals who have their own companies wants to draw out a salary from the company to make sure that because the salary is in the hand of the individual is not taxed, plus salaries becomes a deductible expense in the hands of the company. We'll come on that in a minute because there are a lot of compliance requirements which have been prescribed for owners or owners' relatives to draw the salaries from the company. But in other words, if I'm an employee in a company which is not related to me, I'm just a normal employee, then the salaries, even if I'm earning a 5 million dirhams package, that's not subject to corporate tax.
What about trust?
Trust would be subject to corporate tax to the extent they are doing business or business activity.
If it's passive trust?
If it's a passive trust which is investing in other companies and earning dividends, we'll come on that dividends from residential companies are not subject to tax. Dividends from foreign companies, if you have more than 5% of the shareholding, is again not subject to tax. We believe it has a risk of being taxed. So it requires more clarification from the tax authorities. And in couple of slides from now, we will explain our reasons why a director's fee, not director's salary, a director's fee, sitting fee, if it exceeds 1 million dirhams, could be subject to corporate tax.
If it is property?
Actually, no. It's even if it's from outside UAE, because if the director is resident of UAE, then their global income would be subject to tax.
When you say
So,
director, you are referring to
board of directors, directorship function. So we'll come on the calculation of the tax. The 9% which is the corporate tax rate is calculated on the net profit, not on the gross income. Yeah, so if an individual is conducting a business or a business activity, again, let me clarify. If an individual himself or herself is conducting the business activity, if I am a 100% owner of a company, let's say a free zone company, and then that free zone company is doing the business, that situation is not covered here. This is covered when, as individual, I am directly doing any activity. For example, let's say I'm a photographer. I have a freelancer visa. So the photography activity which I'm doing is a business activity I'm doing as an individual. I am a tax consultant. I have a company, Ask Pankaj Tax Advisors. But suppose I were to take a freelancer visa and directly give the tax advice as an individual, or I am a lawyer, I am doing the litigation directly. These are the situations covered. In such situations, when the individual is doing the business or business activity and their annual income, the revenue exceeds 1 million dirham, the law requires them to register for corporate tax.
So basically all
Sole proprietorship, civil companies, sole establishments, if their income is revenue, not the taxable profit is exceeding 1 million dirhams, they need to register for corporate tax.
So I'm a business owner, I can pay myself $1 million, up to $1 million, pay the salary.
No. On the salary part, I'll come. Just bear with me for some time.
I think you should move on.
Yeah. So bear with me on some point on the wages and salary. There is a dedicated slide on all the compliances which are required. So, but the idea is like as a sole establishment, as a civil company, if there is a business being conducted, they also need to register for tax. Now comes in my individual capacity, I'm the investor, which is a kind of a Thai environment. And I'm investing either in the UAE companies or I'm investing in the non-UAE companies. What is the status on the various incomes that I earn? If I'm investing in the UAE companies, primarily speaking, I may be earning a dividend income or I may be earning income by exiting, that is, by making a gain on selling the shares in the UAE companies. As per the UAE corporate tax law, if I'm earning as individuals dividend from a UAE company, irrespective of the quantum of dividend, whether I'm making 1 million and above, that dividend income is not subject to corporate tax. Similarly, if as individual I have invested in a UAE company and my investment share is at least 5% or more, and then eventually I'm making a profit on sale of those shares, then again the profit that I'm earning as an individual is not subject to corporate tax. Basically meaning that the UAE corporate tax law is that way very, very investor friendly because they don't want to tax any of your investment income, whether by way of dividends or by way of capital gains. It applies to all the investors, so long as the investment is in the UAE companies. In the next slide, we'll come on the investment on the non-UAE companies. Here, there is a kind of a qualifying criteria that unless the company is already listed in a recognized stock exchange, then you need to hold at least 5% of the shareholding of a foreign company, or your investment value should exceed at least 4 million dirham. Either of the situation conditions satisfy, then your dividend income, I'll come on the condition in a minute, your dividend income and your capital gain on sale of the shares in the foreign company is not subject to corporate tax. So again, you can have a peace of mind that so long as you're investing in a foreign company and you're holding at least 5% of their shares,
At least 5%. What is less than 5%?
if it is less than 5% and the value is less than 4 million, then, and it is not a listed stock exchange company, if you are earning dividend from such foreign company and that dividend income exceeds what we discussed, 1 million dirham, it could be subject to corporate tax.
If you're in, so you're saying if I invest in the Nasdaq and I have 10 investments in,
But Nasdaq is a listed stock exchange.
so this
Those, yeah,
this is private company.
private companies. No, so 1 million is a threshold for individuals to become a taxable person. You will still be taxed only on your net profit. So suppose, and there is something called small business relief also we will discuss. But suppose on a gross revenue of 1 million 1,200,000, your net profit is still just 400,000. You will be taxed on the 400,000 only. 1 million is only the threshold to consider individuals to be a taxable person or not.
And who needs to be clear about this?
Sorry?
For citizens, residents,
Any individuals who are conducting the business or a business activity in the UAE. So if as an individual I am conducting a consulting work in the UAE, not under the umbrella of a company.
for this particular situation.
So this is non-UAE company. It would apply only if you are a UAE resident, if you are earning in UAE. Because if as a US citizen you are directly earning income from a foreign company, UAE has no role to play in that. Or alternatively, even as a UAE company you are investing in a non-UAE companies, then this condition will apply. So 3 conditions. It should not be listed in a, it should not be stock in a listed stock exchange. If your holding is more than 5% or the investment value is more than 4 million, then the dividend earned from this foreign company or the capital gain from sale of shares of such companies would not be subject to corporate tax. However, there are certain conditions attached to it. One of the prime conditions, if you look at A, is that you should be holding or you intend to hold this security for minimum of 12 months. In case you do not hold it for 12 months and in between there was a dividend payout which has not been subject to corporate tax, but you sell the shares before the completion of 12 months holding period, you will have to go back and pay the tax on this dividend, if again subject to that 1 million dirham. Again, this is a generic concept which will also applies to the UAE companies investing in foreign companies. So suppose I have a investment company. My investment company invests in a company in Saudi Arabia. That Saudi Arabia KSA company pays me the dividend, but after 8 months, my company sells the shares of the KSA company. Then as the UAE company, I have earned dividend which would otherwise have been exempt if my shareholding period would have crossed 12 months. But because I sold the shares within 8 months, I have to recalculate the tax and offer it to tax to the government.
What if the foreign company is a pass-through type of company like an LLC?
Even if foreign company is a pass-through, so long as I am earning dividend from that foreign company and that foreign company in turn has invested in other companies, my holding period would be treated vis-a-vis that foreign company.
I'm asking about condition B, where it says foreign company subject to higher than 9%. An LLC in US is a pass-through, so they are not subject to tax.
in what situations they are not subject to tax?
Because the LLC is actually not being taxed, the owners of the LLC are being taxed.
So then that LLC would not be paying dividends. We can examine that in detail. I would not be aware of the US taxations in person, but subject to those, only if the company is subject to at least 9% tax, these conditions would apply. Salaries to the owner, I think that's one of the topics on which we have written a detailed article in Gulf News also describing what are the conditions. I think the common thing which was coming across is I have a company, the company is a UAE company. Of course, the UAE company is subject to corporate tax. The company is earning, let's say, 1 million dirhams worth of profits. Can I draw the entire profit as a salary to myself? Because as we discussed, salaries in the hands of the individual is not subject to tax. It's not as easy that you simply draw the salaries, because if we look at the guidance issued by Ministry of Finance and by the FTA, there are a lot of conditions attached, and then there are a lot of compliances which would need to be done. The first is to draw a salary. To categorize anything that I am drawing from a company as a salary or employment, I need to first have a employment contract with the company. And most of us, either who are on a golden visa or who are the owners of the companies, typically do not have an employment contracts or a labor contract with those companies. In the absence of a labor contract, we cannot treat any drawings as equivalent to salaries, even though in our mind we are drawing for the amount of time and the efforts I'm putting for the company. So having an employment contract or labor contract is a must. Then the second thing that we need to analyze more from an economics perspective is the amount that I am drawing from the company, the 1 million that I am drawing from the company, is actually a remuneration for my labor, for my time that I am spending in the company, or is it actually a return on the capital? Because I have created a business, a successful business, the company is now earning good amount of profits, but that's not because I am on a daily basis investing my time. I may be going to the company once in a month, but if I want to draw 1 million dirhams worth of salary, I need to showcase and demonstrate that it's actually a remuneration or a return commensurate with my time and efforts, which would have been done by a third party. In other words, if I would not have been there, some third party, another person would have been required to do those functions for the company. Third, in the UAE, it's fairly common that one individual be owning multiple companies, and what has happened or what we are witnessing is that they are drawing out salaries from multiple companies in one go. Then the question comes is, because I need to claim that I'm an employee in a company, I need to have an employment contract, could I actually draw out salaries from multiple companies? Perhaps, I'm using the word perhaps, perhaps not. Because as a typical employment contract, I would have an employment scenario or a situation only with one or maximum two companies. So the multiple company scenario needs to be examined. I'll just cover this last point. Even if we comply with all this, the law requires that any salaries paid to the owner has to be subject to transfer pricing. Transfer pricing means benchmarking at arm's length. That is, as a company, would I have paid similar salary to a third person who would not have been the owner of the company? So if I am a managing director of Ask Pankaj Tax Advisor, if I am drawing out, let's say, 100,000 dirham salary per month, would the company have paid similar 100,000 salary to a non-owner for doing exactly the similar functions or not. Second, the reverse also needs to be demonstrated, that I am drawing salary of 100,000 because I happen to be the owner of the company. Would any third company who's not related to me is ready to pay me 100,000 for the kind of work that I'm doing? So the both test could be asked by the FTA to be demonstrated to justify that the salary that you want to draw out from the company is at arm's length.
Database or something?
Yes, we'll come on the database in a minute, because the transfer pricing guidelines have been issued only recently, even though they are silent on the owner's salary. You had a question? Sorry. Yeah. I'm through with the slide, that's why.
Well, sorry, I did have a question. So you're saying it's based on historical data, or how will? So you're saying that the ministries, I mean, the FTA is going to come up with regulations or some sort of way to benchmark in the future, or not yet, or it's still unknown?
I would answer it's unknown whether FTA will come up with the guidelines or not, because as I said, only about this week, early this week or last week rather, FTA has issued a detailed guide on the transfer pricing, entire mechanism, the documentation, the process and everything. In the entire guide, they are absolutely silent on this benchmarking of owner's salary, while they are aware that this is a kind of a lingering issue and almost everyone has it. They have also introduced a concept called safe harbor. When it comes to in between the group companies, there are certain non-value add services, like accounting services has been outsourced to one of the group companies. The HR activities have been outsourced to a group company. The guide says that, okay, you don't have to do this benchmarking and everything. A 5% markup is good enough. But when they're introducing this safe harbor, they could have very well said that, okay, owner's salary up to X percentage of revenue should be treated as at arm's length. As of now, they are silent on it. We are expecting they should come out with some sort of a detailed guidance on this.
Is there something that salary calculator?
Might be. We are all expecting, because this is very subjective, that depending on the overall revenue levels of the company, depending on the expertise of the owners or the individuals, the salary levels could vary like from one corner diagonally from one pole to another.
But normally now they have a database of all the salaries and categories and what they can create a benchmark. That can also be used to cap the salaries.
It's an interesting question that, yes, like Glassdoor and all do publish studies as to like each positions in each industry sector, that these are the kind of average salaries being paid. Whether those would be treated as a like the benchmark, possibility is there, yes, is there.
Sorry, just one clarification on the employment contract. Can a 100% owner give himself a contract?
So what we have examined with some of the free zones and like in terms of the Department of Economy, if you are a mainland company, you may still get a labor card either through some of the free zones or through the Ministry of Labor. It's on a case-to-case basis. We have heard positive responses from some of the free zones that they are ready to give a labor card to the owner also.
This would entitle you to credit cards and everything.
More than that, like from showing that you are earning a salary, you can demonstrate that you are working as an employee of the company and not as the owner. Because the risk is that if I don't have an employment contract and I'm earning the salary for my work, forget the dividend and all, then as we said, I may be treated as individual conducting a business activity of providing management or management services to my company. Because like the eternal principle, like there is this case Solomon versus Solomon, if all of us have heard, 1800s, that the owner or the shareholder and the companies are two separate entities. They are not the same. So in which case, as owner, if I am earning my management income, without a labor contract, then I may be treated as doing a business activity of providing management services.
For the extra salary that I get, it, for example, I take 100,000, but I should take 40. The government will consider the 60 is like a profit of the company and will be taxes for the company, isn't it?
Absolutely. So this is where another point, when we started with the point that in corporate tax, it's not a transaction-based tax. So you don't have to fear of penalties. Assuming the situation the gentleman has asked is, okay, I'm earning 100,000 per month as a salary from my company. We do this benchmarking, and throughout the year, I have drawn 1,200,000 as the total salary, and accordingly, the net profit of my company was calculated. We do the benchmarking. It comes out that I am not entitled for 100,000. Maximum I am entitled is 40,000. But I have actually drawn extra 60,000. Is there a penalty for that? Answer is no. The tax law is not a regulatory law to say that no, beyond this point you cannot draw the salary. Point number 2, because the company has otherwise booked the expense, salary expense of 100,000 per month, is there a penalty? Again, answer is no. Why? Because corporate tax will be paid once you calculate your net taxable income from your accounting profit. So currently your accounting profit would have been derived by treating the salary cost of 1,200,000. You will add back 720,000, which is 60,000 into 12 months, into your accounting profit and offer it to tax without paying any penalty whatsoever.
Still regarding the salary. So actually, when you're having a partner visa, you will not be able to get a labor card from labor. So how can we navigate, the salaries for the people who wants to get salary?
We are aware this as an issue, and I don't want to claim that we have some secret solution for which you need to pay us. We are expecting some sort of a clarification to come out from the authorities from FTA, because this is an issue which has been highlighted to them time and again. As I said, what we understand, some of the free zones are ready to offer a labor card. But yes, what you said is true for many other free zones, that they are not ready to give a labor card for a partner visa. Mainland, what we have heard is, yes, they are ready to give a labor card.
In that instance, couldn't they just have a management service agreement between the company and themselves for the amount they get, and then get taxed as an individual and go up to the million?
So, if you have a management agreement between you as an individual and the company, and the total revenue of you as an individual exceeds 1 million, as individuals you need to register for corporate tax.
Yeah, but you could do it up to 1 million, pay yourself 80,000, for example, per month.
Okay.
With under that management service agreement. That's then deductible for the company, and then you're happy because you're clear for tax as well.
Not so easy. Interesting point, interesting perspective. Yeah. But the last point, that even if you are paying to the owner as a management service, it would still be subject to transfer pricing benchmarking. So in which case you'll still end up from that 100,000 back to that 40,000, whether you call it as a salary or a management service. Yeah, transfer pricing is otherwise subjective, but yes, the compliance would come.
So in US, for example, when you start a company, it can be the owner, the chairman of the board, and the CEO. If I understand correctly, this is not possible here.
No, that per se is possible. The peculiar situation in tax comes, the peculiar situation here comes because right now in UAE, there is no tax on the individual's income, salary income. Like in the US or Europe or India, individual's salary or individual's income as director, individual's income as a chairman, all would be subject to tax as individual. Because UAE does not have an individual tax, it kind of creates an opportunity to draw the salary from your own company, and because UAE has a concept of owned companies primarily, to decrease the taxable profit of the company. That's why all these kind of safeguards have been created so that you don't do a sort of a tax evasion around this point.
And the non-salary benefits are also included in this, like perks for management?
Yes, yes. So we'll come on that slide because when it comes to transfer pricing, the expression which is used is any payment to connected person. The connected person definition includes owners, directors, officers, or their relatives up to the 4th degree of kinship. So, and that any payment could be in cash or in kind. So all perks, everything would be subject to benchmarking.
So you have actual employees who are management. For me, my cousin is our branch manager.
Yes.
That he is within the 4th degree. He will be subject to transfer pricing.
He'll be subject to
Salary that I pay him, that I've been paying for 20 years, is subject to.
transfer pricing analysis to say that this salary is justified, it's not in excess.
Sorry, what about incentives?
Including incentives.
Sales incentives?
Any payments to connected person, owners and their relatives will be subject to transfer pricing analysis. I'm only the messenger, I'm not making the tax law, so don't kill me. I'm just passing on what the law says. Then of course, there is an anti-abuse rules which are already in effect, which says that any arrangement that you do without any commercial reason and the only objective is to actually reduce your tax liability, FTA can disregard those arrangements and then simply tax the company at its actual position. So when we talk about anti-abuse rules, one typical situation is, till now I was not drawing the salary, suddenly I start drawing out the salary. Unless I'm able to show that yes, I'm doing work for the company, there is actual investment of time and efforts, then this arrangements of paying salary to oneself could also be covered under anti-abuse rules. Now this is my the best point, I think. Let me see if anyone of you can answer me. So we talked about a situation when we are saying that yes, owners, because they are investing times and energy, are entitled to the salary, and subject to the benchmarking, this salary will not be taxed in the hands of the individual. We also talked about a situation that an individual on a freelancer visa or a sole establishment would be subject to corporate tax if their income is more than, revenue is more than 1 million dirhams. So we can take a case of self-employed individual. As a owner of Ask Pankaj Tax Advisor, I am doing exactly the same function in terms of meeting the clients, making presentations, doing the research and analysis, which I would have done if I would have been working on a freelancer visa. If I am working on a freelancer visa and if the revenue is more than 1 million dirhams, I would not have got any deduction for my time and efforts because I'm a self-employed person. So the question comes that if as a self-employed person, I'm not entitled to deduct any expense from my overall profit, why should I get that benefit just because I'm operating as a company? That's a question we don't have the answer. That would the government deny owner's salary in the future by saying, look, if you would have been doing the same work as a self-individual, you would not have got any deduction. Since you are already a 100% owner of the company, for us, it's as good as you are self-employed. So that question remains. We just wanted to highlight this question.
I have two companies. One company has 100% ownership in the other and hires me as a director in the one that it has ownership. Does that work?
No, it will not work because the tax authorities are as smart as we are. So then they have said owners, directors, officers, connected person, or their related parties. So as owner, if I own another company and these two companies are interacting, then also it's subject to transfer pricing.
If the holding company is abroad,
Holding companies?
if the holding company is in US, for example.
Yes, so the locations of the connected parties is irrelevant. Location of the related parties is irrelevant. They could be the US companies. The transfer pricing regulations would still apply. Any questions on this? So all of us now wants to draw out the salaries. The alternative to the salary, what we have heard from, like when we meet a lot of companies, a lot of owners, and everybody have their own innovative solutions, they said, okay, the transfer pricing applies to salaries, no problem. Salaries cannot be drawn without employment contract, no problem. As we were discussing about like a management service agreement, one of the innovative solution is we will draw out a director's fee. I am the director of the company also. I will have a board of directors fee, and I'll also pay bonus to the board of directors. I've never heard of a concept of bonus to the board of directors, but that's one of the innovative solutions a lot of companies seems to be working on. At this point, we wanted to highlight again, as we talked, individuals could be subject to corporate tax, subject to that 1 million dirham. Whether directorship fee is actually a business activity or not. If I'm working as a board of director, am I doing a business activity? The concept of business or business activity has been defined to include any profession, vocation, anything that I'm doing on a regular basis.
What if you get capital gains in terms of shares?
We'll come on that. Capital gains, if we are gaining, as individual investment, as we covered, is not subject to corporate tax. Sorry? As a director, if I sell the shares, then of course there is no corporate tax. But then I have to like let go of my ownership in the company. I can have a capital gain only if I do away with my ownership in the company. Now on the position whether directorship fee is a business or not for corporate tax. Yeah.
If the company buys back the share,
If the companies
of the director,
If the company buys back the shares, then it is treated as a distribution of dividends only. In the hands of the individual, there is no tax. But like it's like every time you'll have to do a buyback to pay to the owners.
Basically, I can have a vesting
you
period
can do
of 1
buyback
year.
every year.
It's possible.
Yeah, you could have a vesting period of 1 year and then the company will buy.
Fair point. But the question now is, what will be achieved by doing a buyback? Because any amount the company will pay to buy back the shares is not a deductible expenditure. The whole objective of drawing out the salary was I can increase the expenditure of the company and create a income in the hands of the individual which is not taxed. So while the buyback is not taxed in the hands of the individual, the company is still not getting any deductible expense. So effectively the buyback will not solve a tax planning issue because you'll still end up paying the same amount of tax, which you would have paid that instead of buyback, you would have simply distributed the dividends.
How would dividend income earned by holding company towards an investment company be considered? Would that be taxable?
No, so if a holding company is earning the income as dividend from the subsidiary investment, that's not their taxable income. So that will be not subject to tax. So when we do the accounting profit of the holding company, let's say 10 million dirhams, out of 10 million dirhams, we say 9 million dirhams is actually the dividends received from its subsidiary companies. We will reduce 9 million from that 10 million to calculate the taxable profit of the company.
And holding companies in the free zone are required to register for taxes as a threshold?
So any company, whether in free zone or mainland, need to register for tax for sure, whether they have a taxable income or not. So there is no threshold for that. Sorry?
Even the freelancer and freelancer license, they have to register also.
So freelancer will need to register, as we said, because freelancer is nothing but an individual. Only if individual's revenue is more than 1 million dirham, then the individual need to register. If otherwise, no.
So why would the free zone company pay tax? Free zone by definition.
That's a $1 million question. We have slides on that because when it comes to free zones promise not to be taxed versus what is contained in the corporate tax, yes, there are some sort of a disconnect is the right word. Thank you for this. There is some sort of disconnect and more clarity is awaited on this.
The single owner LLC company in mainland would also have to register for that.
Yes. If it's a single owner but a LLC, then it needs to register as a company. So coming on the point whether directorship fee is a business or not, if we take a kind of guidance from what used to exist in the UAE VAT law itself, which was introduced in 2018, from 2018 up till 1st of January 2023, for good 5 years, the directorship fee earned by the individual, they were required to register for VAT and charge VAT on the directorship fee. Only from 1st of January 2023, the VAT law was amended, and this directorship fee earned by the individual has been specifically excluded by way of a provision. Because it has been specifically excluded by way of a provision, that does not take away the fact that it is still a business or a business activity. So if we read that concept into the corporate tax law, if we read that VAT concept into the corporate tax law, if an individual is earning 1 million dirhams worth or more of directorship fee or other business income in aggregate, they may be required to register for corporate tax purposes and undertake the corporate tax compliances. As of now, like while we have written on it in the news columns that we write weekly in Gulf News, there is no specific clarification on this, whether for corporate tax purposes, directorship fee will be subject to, will be treated as a business activity or not. So that's a gray area.
Is this subject to benchmarking in terms of how much does the director pay?
Yes. So if the directors, owners, directors, officers, any payment to these people would be subject to benchmarking anyway.
There's no idea what the benchmark is.
So as of now, no. When it comes to payments to individuals, no. Moving on now from individuals' incomes to companies or startups' income. If you have your own company, one-man company, LLCs. I'll just finish this technical session in about 10 minutes, then we can apply. So moving on from individual now to a company setup when you have your own startup as a LLC, whether in the mainland or in the free zone, what sort of corporate tax implications would be there? One point, as we discussed, any company, irrespective of its location, whether it's in a free zone or in the mainland, irrespective of its income threshold, whether it is conducting any activity whatsoever, even if it's a dormant company, there is no revenue, it needs to still register for corporate tax. You cannot say that since I'm not doing any business activity, I don't need to register. Answer is no. Because you are a company, you need to register for corporate tax.
So that means getting a corporate tax ID.
Corporate tax ID. And then because you will get a corporate tax ID, 9 months from the end of the financial year, you will also have to submit your corporate tax return. That corporate tax return may be a nil return in case the company is not doing any activity. If the company is not doing, actually I'm panting, so that's why I don't want my breathing to be. Irrespective of the profit or the business activity, the corporate tax return still needs to be submitted.
Yes, I want to interrupt you. Before we say that company with less than 1 million income, no need to register. Now you say any company also is not having an income need to register.
Sure. No, thank you for asking this question. What we said earlier was individual earning less than 1 million is not required to register as individual. But if as
Yes, but sorry, an individual earning 1 million, how an individual earn 1 million
So
by a company?
individual can earn 1 million from a business activity.
And the business activity, what is?
It could be like, let's say I gave an example as a photographer. If I have a freelancer visa and I'm doing a photography,
It's an activity, also freelancer visa, it's an activity.
it's a activity, but the status is not of a company. The status is a individual gets a freelancer visa. So I don't get a memorandum of association. I don't have an article of association. As individual, I have been permitted by the government to conduct a business in the UAE. So the freelancer visa is those visas where I am allowed as individual to conduct a business activity in the country. Whereas when I create a company, then company automatically have a memorandum of association, article of association, a trade license to conduct a business activity. So when it comes to a company which has a trade license, memorandum, article, whether they are in free zone or mainland license, they need to register.
Also zero income.
Zero income also they need to register.
Yeah, thank you.
Thank you. Now, so when we talked about, yeah, sole establishment will be treated as individuals. So sole establishment for corporate tax purposes do not have a separate legal entity. They will be treated as individuals, and only if the income of that individual from all the sources as individual exceeds 1 million, they need to register for corporate tax.
Sorry, individual rental income?
Rental income is outside the purview of corporate tax, irrespective of the quantum. So one is when we talk about as a startup, I'm not talking about the large companies. The government has given a relief by way of a small business relief. We are calling it as a SME toolkit. If subject to a particular revenue threshold of 3 million, you don't have to be anxious about corporate tax. And that's the objective of this entire session, conducting this session for startups, founders, that while the tax is new, it could be a bit scary. Please don't be anxious about corporate tax when you are a small and medium enterprise, because the government has introduced something called small business relief. Subject to a revenue threshold, I'll come on the revenue threshold of 3 million. You don't have to pay any corporate tax even though your profits exceeds 375,000 dirhams. So you just have to look, perhaps your gross receipts, very loosely speaking, at your deposit section of your bank statement. If that entire annual income is less than 3 million dirham, for the next 3 years, you don't have to worry about corporate tax, irrespective of your actual profits. You will also be benefited from a simplified tax return. You don't have to submit a detailed tax return. You will also have a benefit of a simplified record keeping, and also accounting method, what is called the cash basis of accounting. So just a very quick question. Anyone who is not aware of cash basis of accounting and accrual basis of accounting? Okay. So the typical accounting is accrual accounting. That is, I have provided you a service in the year 2024. I issue you an invoice. It becomes my income of 2024, even though you will be paying me in 2025. That's the accrual base of accounting, which basically then requires you to keep records of all your invoices, all your expenses, whether or not you have paid to the supplier. A cash basis of accounting is, even though the activity of advisory took place in 2024, even though I have issued you the invoice in 2024, I will recognize my revenue only in 2025 when you make the payment. Similarly, I will book my expenses only once I pay to the supplier, even though the expense could have been incurred in the previous period. Cash basis of accounting is much easier to maintain, because effectively you can just keep your credit card statement and bank statement. At the end of the year, you can calculate your entire net profit. So if your revenues is less than 3 million dirham and you are entitled for a small business relief, you also have an option for cash basis of accounting.
Does this, so this applies only to commercial activity, not dividends, increases in capital?
We'll come on that, because when we talk about revenue of 3 million and below, it includes all your income, gross revenue, including your exempt income. So as a company, if you are earning a dividend of say 2 million and you have your normal business income of another 2 million, for the purpose of small business relief, your revenue will be treated as 2 plus 2, 4 million, and which will take you out of this small business relief. When we are checking this 3 million, we will not be checking whether this income is otherwise taxable or not. We will see all your income in totality of the company.
We have to apply for this SBF.
SBR, yes, it's an option that we have to tick when we have to submit our corporate tax return, which is 9 months from the end of the financial year. Yes, so we don't have to opt for it in advance. That is, starting of the financial year, I don't have to predict that yes, for this year, I want to opt for it. This is actually more convenient that I can opt for it while preparing my corporate tax return and take a decision at that point of time.
You can change it next year?
We can change it next year, yes.
You can defer some costs next year, so you can pay tax this year.
It can be strategically planned. It can be strategically planned, but this is a scheme which is essentially a support scheme because taxation is new to the country. So the government has given it as a support to the small and medium enterprises for 3 years. As of now, there is no confirmation that this will be an ongoing scheme for all these startups beyond 2026. So this is more
First year comes only in 26, right? Not 25.
24. Because corporate tax has already started for financial year starting on or after 1st of June 23. So for like most of the companies who are following Jan to December, so Jan to December, thank you so much. Jan to December 2024, it would be the first financial year. 2025 would be the second one. And Jan to December 26 would be the third financial year, beyond which, as of now, the small business relief is not proposed to be continued.
So if your financial year started on the 1st of June this year, you're already in your tax year. And you're then going to have to do it 9 months afterwards. 9 months after next June. Yeah.
If your financial year is June to May, then it has already started. And 9 months from 31st of May, you have to submit your tax return. First, as we said, even if you are eligible for small business relief, even if you are otherwise falling under the category of SME, do register for corporate tax. It's mandatory. As we stated in the beginning, as such, there is no timeline to register. As such, there is no penalty prescribed. Because there is no penalty, there is no timeline, so there is no penalty prescribed. But it is still recommended that you register as soon as possible. Amongst various categories of taxpayer, certain categories like foreign companies and all, the registration module is still not open. But if you are a UAE company, whether in free zone or in the mainland, the registration module is already open on the Amara tax portal. And you can register. It's fairly a simple exercise. It's not very complex like a VAT registration. Second, this is when we talk about 3 million dirhams limit. Check your eligibility, whether you are eligible for small business relief or not. Now, in terms of eligibility, because we are talking on year, first is gross revenue of each year should not exceed 3 million. I'll give you an example. 2024, 2025, 2026. We are talking about 3 years. Assume your gross revenue of 2024 would be less than 3 million. You are eligible for small business relief. Your gross revenue of 2025, let us assume it exceeds 3 million, becomes 4 million. Then for the year 2025, you are not eligible for small business relief because the revenue is more than 3 million. Come to the next year, which is 2026, your gross revenue falls back to less than 3 million. Question is, would you be eligible for the small business relief in that year because the revenue is less than 3 million? Answer is no. Answer is not yes, answer is no, because your revenue in all the 3 years or the previous years should be less than 3 million. So once you lose that benefit, then you lose it for any subsequent year, or assuming this scheme is continued for the future years, you might lose it for next year also. Now when we talk about, as we talked, whether it includes dividend, whether it includes interest, gross revenue includes any sort of income that the company is earning. Now before we come on dividend and interest, like a typical example which we have seen is a manpower supply company. So manpower supply company does what? It recruits people, pay them the salary, and then deploys this manpower to their clients, and they have a, let's say, a fixed margin of 10% or 15% on the salary cost. For all practical purposes, the manpower company considers that markup of 10-15% only as their income, because they think otherwise salary is my cost, I'm recovering the salary from my client, plus I'm earning a 15% markup. But when we are talking about small business relief, we will talk about the gross revenue, not your net markup, net profit. So as a manpower supply company, if you are recovering the salary plus a markup, the entire amount will become your revenue for checking this threshold of 3 million. This revenue is of course exclusive of VAT. It includes any income that you are earning as that company, whether it's from your scrap sales, asset sales, as we said, sale of business, even including the exempt incomes of dividend and interest. So even if the dividend is otherwise exempt in the hands of the company, whether that dividend is earned from a domestic UAE company or that dividend is earned from a foreign company investment that you have made, all such incomes would be included to check of this 3 million threshold, whether you are eligible for SBR or not. Now this is important. When we talk about, as we talked about, in cash or in kind, even for small business relief, revenue in kind has to be included for checking this 3 million threshold. So for example, as we said, social media influencer, what we understand, the social media influencers cannot take cash unless they have a license to operate as a social media influencer. So many a times they take their fee in consideration, they take their fee in kind. So even that fee that they are taking in kind, a barter value system, all those values has to be included or has to be factored in to check your small business relief eligibility. So take for example, if you deal in the business of car dealership, I tell you that I will provide you a tax advisory services for next 1 year. Instead of paying me a fee for my services, you please give me 1 car. So you transfer a car in my name and I will provide you the service.
Review of product online and keep the product.
Yes, something like that. But it's not just for the social media influencer. Even in a like as a normal business, like just to share a trade secret, there are certain situations where as a tax advisor, as a goodwill gesture or maybe as a matter of respect, with some of the clients, we don't charge a fee in cash. We would do work and we would just perhaps take some of their services or goods in return, just as a matter of respect. So that for us becomes a barter transaction both for VAT and for corporate tax purposes.
Yeah, I wanted to ask regarding these tech marketplaces, where the GMV is the trade which happens on the platform, and let's say
the take rate is a margin and which is recognized as revenue for them. In that case, how the consideration is going to be there for revenue?
So you might have to explain me in a bit more detail. I am not aware of this GMV concept and all.
So basically in tech marketplaces, usually whatever gets bought and sold is recognized as GMV, gross merchandise value.
Okay.
While the take rate, which is a margin of the marketplace, is recognized as revenue by them. So in that case, you gave an example of the manpower supply. It works actually similarly. How will the revenue be recognized?
So, if I use the example of Amazon, just for the sake of it.
Amazon is one example, yeah.
So, what I'm understanding from you is like Amazon may say that for the Q1, the gross merchandise value on my website was 100 million dirhams. But Amazon may not be buying those products. Amazon is saying the quantum of business conducted through its platform.
That's right.
That quantum of business is not, we are talking about 3 million. We are talking about what would have been otherwise the revenue of Amazon.
Real revenue.
Real revenue.
So that
Not real revenue, accounting revenue. Accounting revenue.
Money that comes as real, as sales or revenue.
Yes. For something for which Amazon would have issued invoices and recognized as its income in its books of account.
So there are two things that Amazon is doing. One thing is fulfillment, where they actually would be doing a back-to-back buy and sell.
Yes.
Where
So
the
that will be included.
The sales receipts are going to come in name of Amazon, which will be recognized as revenue. The other is the facilitation, which happens as a where they charge a take rate.
Take rate, yes. So there the commission is only the revenue.
Okay.
Yeah. But the amount of business done on the platform has no correlation with 3 million.
Okay.
GMV, I don't think anybody books as revenue in a audited account. Yeah. But if it's not booked as revenue, then it's just also that.
But the example which was given here about the manpower supply was a similar kind of thing, where the manpower would be taken and the wages would be taken as
Yeah, effectively, anything that you bill in the invoice, just to make it simple, if you raise an invoice and you say sale of services or purchase, that is your revenue, and that goes into account. Anything that goes into accounts and you get exactly the same amount of money in your bank account is revenue and income for this purpose. Anything else is just not right.
So let me ask you a question. I think if I have picked up the point correctly, for a manpower supply company, let's say the salary recovery is 10,000, and on which they are charging 500 as their markup. On what value, according to you, they should charge VAT? 10,500 or 500? That's wrong. Because, and this is a typical FTA audit point, and a lot of manpower companies have been penalized, that revenue for the manpower supply company, even for VAT purposes, is 10,500. Which is their billing, and on which they should charge VAT. Initially in 2018, 2019 specifically, most of the manpower supply companies were charging VAT only on that 500. So the moment they start recognizing 10,500 as their revenue, this will get automatically resolved. So as we said in the beginning, and like kind of correlating all the points which I said in the beginning, for corporate tax, my team might bash me up. Like for VAT, of course, we bring a lot of value add because it's a transaction-based tax. For corporate tax, if you do your accounting with an absolute robust manner, you don't need a consultant, at least in the initial period. You might be required at the end of the financial year. But do your accounting correctly.
Complicated after year 3-4 is when you need it.
Yeah.
What does the transactions with the
Yes. So as we said, small business relief, each entity would be below 3 million is eligible for small business relief. I may have two companies under me, one doing a tax advisory, one doing accounting and bookkeeping. In between the two entities, I may have certain transactions, maybe in terms of one resource being engaged in the other resource and everything. Each of those transactions also should be at arm's length, because it should not so happen that because one company, accounting company, is invoicing to the manpower, to the tax advisory company, if the invoice value would have been, say, 100,000, I was going out of this 3 million threshold. So what do? Both companies belongs to me. I undervalue that invoice. So the law requires, even if you are eligible for small business relief, and as that small startup or a small and medium enterprise, you are doing transactions with your related parties, which could be your family relatives company. All those transactions has to be at a benchmark or at arm's length. Arm's length means fair market value.
Do they have the wherewithal to do all that stuff? You know, the benchmark is very lumpy. You know, we know what benchmarking happens in US and other places, they still struggle. But for this, when you are just taking off as a tax jurisdiction, it's good that, okay, we'll be aware, we can't under-invoice, underplay, we'll be conscious. I think it's more from that platform. I don't think FTA will have the wherewithal to do.
It's a brilliant question. If I were to answer it honestly, which might be disappointing to everyone here, while as taxpayers we have to do this compliance now, the tax authorities have 7 years to audit this, and in this 7 years they will gain that wherewithal, the knowledge and everything to come back and then audit and say that no, this thing was done incorrectly 7 years back.
As long as no blatant violation by paying salaries of 200,000 or 150,000 a year and there's no salary, I think we should be fine.
I won't comment on it right now because I wouldn't like to indemnify.
We start blatantly screwing up the system so well that the tax authorities will have to, you call them at a doorstep.
What has happened if I take the experience from VAT and what we are examining recently, VAT was as new as corporate tax is today. It was as new in 2018. Companies did make mistakes and not like no tax fraud or anything out of their ignorance. But the fact remains they are getting penalized now. So, and they are getting penalized heavily for all those mistakes and everything. So learning from that experience, and it's not that as consultant we want to create work for ourselves. Learning from that experience, we are telling the companies that look, nobody like FTA may not have that knowledge right now or that manpower to do that scrutiny now, but they have 7 years. So do things correctly now.
There is always precedence that you
When you say 7 years, it means they will start to do audit in 7 years, or they can start in 2025?
They can start, they have maximum of 7 years to do an audit. So they can start in 2025. Yes. Yes.
You're talking about the prescription period, but can't you get an advance ruling on your taxation by going to the authorities if it's large enough?
Certainly. There is a concept of a private clarification we'll be covering in one of the slides, that we can go to the tax authorities to check on a taxability of a particular point or say a deductibility. But on the transfer pricing margins, there is something called advanced pricing mechanism, advanced pricing agreement, APAs. So in the federal decree law, there is a reference that we can approach the FTA and agree on an advanced pricing agreement that vis-a-vis my salaries to the owner or vis-a-vis my transactions with the group companies, this is a kind of margin because of XYZ reasons. And if FTA is agreeable to that, they pass on a written order, then we are protected. But so that's a separate exercise which can be done for sure and recommended also.
Does it actually happen?
In other jurisdictions, yes, very much. APA is fairly common. So in fact, when it comes to transfer pricing specifically, and like APA is essentially for transfer pricing, APA is a transfer pricing agreement between the taxpayer and that country's tax authority. There is also something called mutual agreement procedure. So wherein if I have a transaction as an Indian company with my US holding company, I can apply for a mutual agreement procedure wherein US tax authorities and the Indian tax authorities will meet. They keep meeting every quarter, every month or something. And there are applications pending with all that detailed analysis given by the consultant. The country's authorities agree that yes, for let's say a back office services provided by Indian subsidiary to the US head office, the markup should be 15%. Then both the authorities cannot question it till the time the facts of the transactions remains the same. So it happens. We are hoping, like knowing certain things from the way we have seen in the public awareness sessions, and I don't want to claim that we have some inside knowledge, but based on the public announcements and all, I think yes, the authorities will go for that direction.
One question, you discussed about the owner salary.
If you are paying to an absolutely unrelated person 1 million because the work demands that, you can do that and that the transfer pricing will not apply. Because the assumption of the law is that every taxpayer is prudent enough that they would not pay anything in excess of what is the other person or other party deserves.
Yeah, but I can be the owner and I can be not the director.
That's possible. That sort of a tax planning or a tax avoidance is not recommended. Just a couple of things when it comes to the SBR or this SME toolkit. Do check your exclusions. There are essentially 2 or 3 exclusions. One, that even though your revenue is less than 3 million, you should not be a part of a multinational group which is earning more than 3 billion dirhams worth of revenue. So it could so happen that, let's say, a big multinational have just set up a new office in UAE. The office otherwise is earning less than 3 million, but because it's part of the multinational group, they cannot opt for the small business relief. The second is a qualifying free zone person. If you are otherwise availing, and it's kind of a counterintuitive, if you are otherwise availing the free zone benefit of 0% tax, you cannot avail the small business relief benefit. And third is, so a qualifying free zone person is entitled for 0% tax on its profits. Free zone company, so satisfying some of the prescribed conditions, is a qualifying free zone person. Will be doing free zone. So if time permitting. A qualifying free zone person is a free zone company satisfying some of the conditions. Once they satisfy those conditions, they are anyway entitled for 0% tax. Because they are entitled for 0% tax, they would not anyway need the small business relief, irrespective of their revenue threshold. So to that extent, this is counterintuitive. There is a technical scenario why this and small business relief will gel together, but for the sake of audience, I'm not getting into that. That's like too much of a flowchart. If this, then both situations will apply. Third, you can avail the small business relief only if you are a UAE company. It applies on individuals also, right? Yeah. If you are a UAE company, or as we said, you are an individual earning more than 1 million dirham as your personal business activity. If you are a non-resident company, if you are a branch of a foreign company, then you would not be entitled for a small business relief. So this we have already done, that you have to opt for the small business relief while you are filing your corporate tax return, which is due 9 months from the end of the financial year. You don't have to take that position now. You don't have to take that position from the start of the financial year, whether you are going for this benefit or not. So only at the end of the year, you can examine your revenue status, everything, and decide whether you want to go for it or not. The last step, first question, please act prudently. When we say act prudently, I think when this small business was announced almost about 7-8 months back, the first immediate answer, especially the owners who have like a business, okay, I'll set up 4 more companies, I'll split the revenues in each of the companies and keep it less than 3 million. There is a specific anti-abuse rule wherein tax authorities could examine that how many companies do you own, what is the kind of financial interdependence between those companies, what are the nature of activities of those companies, and are you artificially splitting the business so as to avail the small business relief. So please don't be very aggressive with your tax planning, act prudently. As we said, prepare for tax in 3 years. As of now, this benefit is proposed to end by the financial year ending 31st of December 2026. Whether it will continue or not yet known, but at least as per the guidance issued by the tax authorities, it's only a support measure for small companies to adjust to the new tax regime. So it's quite likely that this may not continue. Having said that, even though you don't have to pay tax, even though you are otherwise eligible for a simplified tax return, please maintain your documents and records, because authorities could still check what was your actual revenue, whether you are otherwise eligible for small business relief or not, was your revenue actually exceeding 3 million. So even though you don't have to pay tax, does not take away your obligation to maintain the records and everything for the next 7 years.
When you say material code, you need to do an audit or not?
Sorry?
Just to keep looking at
Yes, so there is no audit requirement here. We don't have to get the audit done, but we need to maintain our records and documents of our invoices, bank statements and everything, because the authorities may like to review that if authorities would like to audit you directly. But you don't have to submit any sort of audited financial statements. Yes, we have done. So, again, a slightly technical. As we said, one has to opt for a small business relief at the end of the financial year while submitting your tax return. There would be a couple of selection criteria. So, for example, if a company has actually incurred a loss instead of earning a profit, then there is no requirement to opt for a small business relief. Then you may as well file your corporate tax return declaring the tax loss, so that you can carry forward that tax loss to the following years. Because if you opt for a small business relief, despite having a tax loss, you cannot carry forward that tax loss to the subsequent tax period.
Even if, as long as you don't fall under the threshold, you don't have to file, right? From SBI.
No, we still have to file.
No, you file the tax, if you don't ask for SBI.
We don't, yeah, we don't ask for SBI. Yes.
Loss or below
Below the thing, yes.
375.
No, 375 is irrelevant. So long as I have a profit, but revenue is less than 3 million, I should go for SBR. Actual profit, so let's say my revenue is 2,090,000. My actual profit is 2 million. Because my revenue is less than 3 million, I don't have to pay any tax because I'm eligible for SBR. So that's a huge advantage, so to say, if like, especially in a industry like tax consultant and all, where we don't have an operational cost. We just have our own manpower, like our own cost. The profit markups may be slightly high compared to a manufacturing industry. So long as the revenue is less than 3 million, irrespective of the actual profits, I am still eligible for the SBR. Similarly, the second move. Shall we take more question answers now? Or like, what's your time? Well, I have a lot of things to cover, that's what I'm saying. So shall I get into it? You're okay with more 15, 20 minutes of technical discussions and then we open the panel discussion? Great. Right, thanks. Now, in terms of financial statements, as we said, while the audit requirement is there, only if your revenue is more than 50 million dirhams. My colleague is smiling because I always mess up this limit. I either say 200 million, I say 20 million, but now I've said correctly. If your revenue is 50 million and above, revenue, not your income, taxable profit, you need to get your financial statements audited from auditors, like perhaps to be prescribed, hopefully as a prescribed panel or something. However, you still should be maintaining your financial statements anyway, because end of the day, you will be preparing your tax return based on your financials profit. So your financial records, as we have been saying, your accounting and financial records should be the most robust, most structured, and supported by documents. When we are creating those financial statements as a SME or as a startups, couple of points that you need to take care. Something called chart of accounts. Chart of accounts means how many categories you are dividing your income, in how many categories you are booking your expenses. Make them as detailed as possible, because there are certain expenses on which you would not be getting a deduction as expense. Take for example, gifts that you would be giving to your customers and everybody, you don't get the credit or an expense deduction for it. The donations, unless it is to a qualifying public benefit entity, you don't get an expense deduction of it. Certain entertainment expense in terms of accommodations, transportation, meals with your customers or with your vendors, you only get 50% of that amount as your expense deduction to calculate your taxable profit. So please, when you're booking your expenses, like many startups do that only in Excel, perhaps subscribe to a accounting software so that you have these records documented properly, because you would need these records for the next 7 years. The payments to related parties, to connected person, as we just discussed, identifying the related parties. If you are genuinely engaging your relatives, your family members, your distant cousins and everything, while the law does not prohibit such engagement and anything, but the law requires you to identify the payments made to such people, and then you need to do the transfer pricing compliances. Similarly, the biggest example is the expense conducted, whether it's for a business purpose or a non-business purpose. Now, just to kind of take a real life situation on a lighter note, I am a tax advisor. Like most of the work is done by as individual, by the team members and everything. Assume the fact that I'm panting and everything, God forbid if I require, but I have to go through a bypass surgery. So the company helps me getting a bypass surgery done, incurs all the medical expenses for the bypass surgery. Is that a business expense? Yes, no? How many says yes, it's a business expense? And how many says no, not a business expense? Still, a couple of them are not raising hands.
Business looks at you as an asset.
Yeah. So the question is, am I working as a plant and machinery to the business? The repair to plant and machinery is eligible expense,
Yeah.
right? As individual, am I working as a plant and machinery for the business? Just to give an example, it's a real life situation, not with me, of course, thankfully, not it. But in a situation in the Indian tax laws, individual lawyers are also subject to corporate tax, like the income tax, so to say. Now, one of the lawyers actually had to go through a bypass surgery and claimed the expenses as a business expense. The matter went all the way to the apex court, the highest most court, whether it is eligible as a business expense or not. And the court held yes, just like the repair and maintenance of a plant and machinery of a business, the lawyer's body was, the heart was nothing but the plant and machinery for the advocacy business, the litigation business that they were running.
But in which country they say yes, you can deduct?
This was India. The example which I'm saying is India, but
In Dubai?
in India. But when it comes to case laws, when it comes to taxation cases, it is fairly common that the principle of one country could be adopted or could be used in the courts of other countries. So we'll have to see
There
how.
are some tax jurisdiction in Europe where all the medical expenses you can deduct.
Absolutely, yes.
Because that's the government law.
Yes. Absolutely. So that's where.
Everything, not only a surgery. Also, if you go and pay a private visit to a doctor and it costs you $300, you can deduct.
Surely. And we expect that same principle should be followed in UAE also. We expect. But that clarification is yet to come. But at least the way the law has been worded, there is nothing contrary which has been specified. So it appears that it should be allowed as a deductible expense. So similarly, there are other expenses which may or may not be deductible. So perhaps now is the time even for startups and SMEs to move above the Excel sheets and maintain a proper records for it. Financial statement, as we said, whether audit is required or not, it's always good practice to maintain because that will be your basis to prepare your tax returns, and goes without saying, please comply with the tax laws.
Where can we get lists of expenses which are claimable or not?
So a broad category of list has already been specified in the corporate tax law. There is a section of corporate tax guide frequently asked questions on the Ministry of Finance website. There also you'll get it. Towards the end of the slide, we'll be showing you a QR code of our WhatsApp community where, as Ask Pankaj Tax Advisors, we will be sending periodic updates. You can just join that community and you will be getting the updates. So this is something we have already covered, so I'll kind of quickly run through it, that any payment to a connected person, which is owners, directors, officers, or their related party, which includes their relative up to the 4th level of kinship, any such payment needs to be benchmarked that the amount or the quantum of that payment or that transaction is at arm's length, what you would have done with a third party or unrelated party.
So if I have a friend, and he has a company, I have a company, and he hires me in his company, so I get a salary in his company, and my company pays on an invoice some sort of service to that company.
It's like two people meet on a boat, you kill my enemy, I kill your enemy. Nobody will know.
Does that count as connected persons?
No, while friends would not be counted as a connected person, what could be seen if suppose the tax authorities gets to know such kind of arrangement, because end of the day, while you are drawing the salary from your friend's company, you may not have the attendance record in his company, his or her company. You may not have emails which can demonstrate that you were actually involved in the business activities of your friend. So then the tax authorities can question that you have paid a salary to a person who has not even worked for the company. So that risk is always there. Bear in mind, there is already a whistleblower scheme which FT has introduced for VAT, which will be continuing for corporate tax also. And like this is a typical risk. If I can say in general words, generally any disgruntled employee or a person can adopt or use these kind of whistleblower scheme to report such kind of arrangement, which anyway should not have been done at first place. Free zones. How many of us are interested in free zones? Then I'll go into the absolute detail of free zones. Okay, perfect. So we said when you set up the free zone companies, the free zones authorities have generally promised a tax holidays, whether 25 years or whether 50 years and everything. Now, when the corporate tax was announced, and then when it was white paper was introduced, and then finally the decree law was announced, the government has always said that they will honor the tax exemptions promised to the free zone companies. So why we are stressing on this point? Because many a times, typical question that we get asked, that as a free zone company, I am 100% exporting my services. I am a free zone company. I am providing tax advisory services only to the overseas client. Should I have to pay tax? Answer is yes. For the simple reason, the corporate tax law does not per se contain any incentives for export. Please do not mix export incentives with free zone that we are about to discuss. The corporate tax law does not per se contain any tax incentives to promote exports. It is only saying that we will honor the promises made to you as a free zone company subject to certain conditions. With that in mind, there are 3 categories of income which are eligible for 0% tax rate. First is a transaction of a free zone company with other free zone companies. Now this transaction could be in goods or in services, but so long as you are transacting with other free zone companies, whether in the same free zone or in another free zone. So you may be a Jafza company, you are transacting with a company in Shams or in the Ras Al Khaimah free zone or Dubai South. All such transactions would be covered under category A, which is otherwise eligible for 0%. Category B, prescribed transactions, what is called qualifying activities, if you are doing with any person. Now this any person means mainland customers, other persons could be your overseas customers. But these incomes should be from those qualifying activities only, then they are eligible for 0%. In both these categories, there is something called excluded activities. We will come on that separately. And then third category is, other than these 2 categories, if you have any other income but subject to a de minimis limit, then you are eligible for 0%. If certain conditions are not met, especially the de minimis limit, category A and category B, which is otherwise eligible for 0%, will also be taxed at 9%. So it is not a scenario that, okay, this category of income 0%, this category of income 9%. Either you are in it or you are outside it. There is no midway that, okay, this much I will tax and that much I will not tax. So you need to make sure that you are meeting the conditions.
Okay, so you're a free zone company, providing services, whatever it is. You're a free zone company, you're providing services to mainland operations, whether that's consulting or whatever else that is. It's non-qualifying income, correct?
Yeah, so we'll be just discussing what is qualifying activity, but the question asked by is a free zone company providing consulting services or any services to mainland customers, do they have a scope of 0%? Answer is no, because the customer is mainland, category A does not apply. Because the customer is mainland, for category B to apply, the activity should have been a qualifying activity. But incidentally, services are not covered under any of the qualifying activity, and hence they will be subject to 9% tax.
Excuse me.
Company sells services or goods to a foreign country. Is this income taxable or not?
So if a free zone company is providing services to the foreign customers, anywhere, if it is service, then the qualifying income does not apply, 0% does not apply. If it is, it is taxable. Services to overseas customer in Africa, everywhere, services is taxable.
And export of goods, let's say from Jebel Ali, you are exporting chair.
We'll come on that, scope of qualifying activity, whether it is covered or not. Now, while we are talking about excluded activity, this exclusion is separate, which we are showing on the right side of the panel. So the left side of the panel, subject to certain conditions, is eligible for 0%. In addition to that 0% income, certain categories of income are excluded from that 0%, means they will be taxed at 9%. First is income attributable to your domestic permanent establishment. Now, domestic permanent establishment, broadly speaking, means if you have the business being managed from mainland. So you may have a free zone company, but the entire management sits out of a mainland company, and then they are operating that business from the mainland. So the entire income will be attributed to the domestic permanent establishment because the management is sitting in the mainland. So that income would be subject to 9%. That income which will be attributable to permanent establishment in the mainland will be subject to 9%. I'll give you a simpler example. You have a free zone company which is distributing goods, selling goods and everything. For a moment, assume it's 0%. This free zone company has a branch in the mainland. And to the extent of certain selected customers, the branch imports the goods and then sells the goods to the mainland customers. Because to that extent, the business activity has been done by a branch, and branch is a domestic permanent establishment of the free zone company, the profit earned by the branch will be subject to 9%. Only that. Only the profit attributable to the domestic permanent establishment would be subject to 9%. In certain prescribed scenarios alone, free zone company owning a commercial property in a free zone, giving that free zone property to another free zone person would be subject to 0%. In all other scenarios, it will be subject to 9%. Right? Am I missing something? Okay. So if a free zone company owning a property in the mainland and then leasing it out, earning a lease rental, that income would be subject to 9%. But in addition to that 9% income, if it is also earning one of the qualifying activities, that still remains protected at 0%. We'll come on that. So when we talk about the first category, which is transaction from a free zone to another free zone between the free zone entities, the point that you need to consider and keep in mind, the free zone company, the recipient, should be the beneficial owner, beneficial recipient. It should not so happen that you are artificially showing a free zone to free zone transaction and that free zone recipient in turn is supplying it to its mainland branch or its to a mainland subsidiary. So the government will check that it was a genuine free zone to free zone transaction. You have not artificially created another free zone person just to claim the corporate tax benefit. Now this is where the qualifying activity is relevant. There are 13 categories. First, if we kind of subcategorize, there are 13 activities which have been specified as qualifying activities. Again, rewinding the context, income from qualifying activities, whether you are earning from a mainland customer, income from qualifying activities if you are earning from your overseas customer, whether in Africa, US, Europe, anywhere, so long as that income is from qualifying activity, it is eligible for 0%. So that's why we are examining what are qualifying activities. Manufacturing or processing of goods in a free zone is a qualifying activity. So if you have a manufacturing facility in a free zone and then you are manufacturing goods and then you are exporting the goods or you are supplying the goods to a mainland customers or you are only processing the goods, you are not creating any new goods and then you are supplying those processing services, you are doing only the processing charge, the goods do not belong to you. If the goods belong to you, it might have amounted to a manufacturing activity. Then those incomes will be subject to 0%. Holding of shares, headquarter services to related parties, treasury services to the related parties. This is only the very specified categories of services. We are not talking about general category of service of tax advisory or anything. If you are providing treasury services to your related parties, if you are providing headquarter services to your related parties, or if you have a holding company in the free zone which is earning dividends and all, they will also be subject to 0% tax. Income from these activities will be subject to 0% tax. It will be 0%. Unfortunately not, because when we talk about those excluded activities, the income from IP, income from intellectual property, trademark, software, know-how, is specifically excluded from 0%. So if any company is earning, a free zone company is earning a royalty or a trademark fee or a copyright fee, whether as a licensing or as a sale purchase, they are subject to 9%. Distribution of goods, which is trading of goods from the free zone, from a designated zone, is subject to 0%. Designated zone as a concept of VAT is a fenced zone. Only to the extent of fenced zone, if you are doing distribution activity, you are eligible for 0%. As of now, there is no clarity that if you are doing a distribution outside the fence zone, whether or not you will be eligible for 0%. Typical example, you are a company based inside the fenced zone of Javza. All of us are aware of Javza. There is a fenced area where you cannot enter, exit freely. You have to take the passes, PCFC pass. You have a company based inside Javza. That company import goods, re-export, or sells it to a mainland customer. That company is doing a distribution activity in or from a designated zone and hence eligible for 0%. Even though it is selling the goods to a mainland customer, it is eligible for 0%. This company purchasing goods from a China supplier and then selling it to a US customer, goods going directly, what is called third port shipment or direct shipments. While the law is currently silent on it, there was a public consultation document released in August. It indicated that these kind of direct shipments may also be eligible for 0%. But if a free zone company is not in or from a designated zone, so other zones like DMCC, for example, which is not a free zone, which is not a designated zone right now, that company based in such free zones doing a direct shipment, goods going directly from India to Europe, that may still be subject to 9%. All of us, I can see that anticipation in the room, including ourselves, are waiting for more clarity on this. While this issue has been raised time and again, the public consultation document also kind of referred these kind of scenarios, but the final word of law in terms of decisions are yet to come out. But in this context, please bear in mind, the law does not have any export promotion incentives. All that they have said is, we will honor the tax incentives or tax holidays promised by the free zones. And then there are a couple of other activities. I'm just running them through for the paucity of time. So there are a couple of designated zones which have been announced under the VAT law, which by definitions are the fenced zones under which the movement of goods and people are controlled, are not freely available. So Javza is one, Dubai South, the logistics city is another one, Dubai Airport Free Zone is another one, Sharjah International Airport Free Zone is another one, Kizad. So there are listed under the VAT law, the designated zones.
So this sounds more like the designated zone is like the real free zone, and the others is almost free zone.
It depends on the activity you are taking. So if you are in the business of distribution of goods, what you are saying perhaps holds true. But suppose you are a manufacturer and then you are in a normal free zone, then again you are eligible for the tax incentive. So it's all subjective to the nature of business that one is doing. Reinsurance services, funds management services, because they require specific licenses, if you are doing from a free zone, again would be eligible for 0% tax. This is another important aspect often ignored whenever we have conducted such workshops. Like there's always this sense of, oh, okay, this is also an additional condition. We always thought we are a free zone company, we are doing any of those activities, we are eligible. But there are other conditions also that needs to be complied to be eligible for 0% tax rate. First is you need to maintain adequate substance. It uses the word state, but please read it as free zone. You need to maintain adequate substance in the free zone. What is adequate substance? How do you demonstrate adequate substance? We have a dedicated slide on that. You need to, of course, derive the qualifying income, any of those 3 categories in the qualifying activities, those 13 categories. You should not have opted to tax, because as a free zone company, you still have an option to tax. You should not have opted to tax. You comply with Article 34 and 55. Essentially, 34 and 55 talks about transfer pricing compliances in terms of documentation. And as a free zone company, your transactions with related parties and connected persons should be at arm's length. And then you meet any other conditions prescribed by the minister. The any other condition basically is you have to have audited financial statements. So irrespective of your revenue level, if you want to avail the 0% benefit, you need to have audited financial statements. Now, what is adequate substance? Oh, sorry, I'll have to come on de minimis also. But let me cover adequate substance and then I'll come on the de minimis back. Now, adequate substance basically means or basically requires that for you to be eligible as 0%, you need to demonstrate that you are actually a free zone company. You are doing all your work, everything, operations in a free zone. So it essentially requires that you need to have your core income generating activity, depending on the context of business, whether you are a logistic company, whether you are a distribution company or not. Your core income generating activities should be performed in the free zone. While these activities could be outsourced to a related party or to a third party, but that related party or third party should also be in a free zone. So overall, the core income generating activity should be conducted in a free zone. The second, which is directly not written, but I'll tell you why we are covering this, that you need to have your management of the company, management of the free zone company being done from the free zone itself. Because if you do not have your management in the free zone itself, then you have a risk of creating a domestic permanent establishment, which is where the place of management. If your place of management is the mainland, it creates a domestic PE. The law says any profit attributable to domestic PE is subject to 9%. So you have to indirectly make sure that your CEOs, marketing managers, sales manager, they operate out of the free zone. They cannot operate out of the mainland. Then of course you need to have adequate number of employees commensurate with your business operations, business activities. You need to have adequate amount of expenditure, operating expenditure, and you have to have adequate amount of physical asset commensurate with your business operations and the revenue levels. There is no minimum threshold or a maximum limit. It is subjective on a case-to-case basis, which needs to be decided. With this, just coming back on the point of de minimis, I think I have by mistake deleted the slide of de minimis, but I'll come on this. So if you see, category A and category B are the defined incomes which are eligible for 0%. The law says that you have any other income which is not falling under category A and category B, you can still be eligible for 0% under category C, but only if it does not exceed de minimis. And the de minimis limit is 5% of your total revenue of the free zone company, or 5 million, whichever is less. So for example, you are a manufacturer in a free zone as a manufacturer in free zone, you are earning 100 million worth of revenue, not taxable profit, 100 million worth of revenue. In addition to the manufacturing operations, you are also providing, let us say, after sales or extended warranty services. Extended warranty is a service, and your revenue from extended warranty is 10 million. Because 10 million is more than 5% of 100 million, you have to pay 9% on your entire 110 million worth of revenue and resultant taxable profit from that. So the moment you lose So when we talked about these additional conditions, the non-qualifying revenue should not exceed the de minimis limited, because the moment you do not meet this condition, you cease to be the qualifying free zone person. And accordingly, the moment your extended warranty revenue is 10 million, you lose the benefit of 0% even on that 100 million. Another example, which is, let's say your manufacturing revenue is 200 million and your extended warranty revenue is only 6 million. 6 million is less than 5% of 200 million, but it is still more than 5 million. So the de minimis limit is 5% of the revenue or 5 million, whichever is lower. In that case, again, you will lose the 0% benefit on entire 200 of manufacturing revenue and resultant profit plus 6 million of extended warranty. The logic for doing this is that the company does, the government does not want to say that. The government is saying, as a free zone company, you are authorized to do only XYZ activity. If you are doing anything additional, we understand as a matter of business you might be required, but we want to put a cap on it. It should not so happen that you are doing manufacturing of only 10 million or say 20 million, and you are doing a service of 100 million, you are still enjoying the 0% on 20 million.
So there is no part tax.
There is no part tax. As we said, either you are in it or you are not in it.
That essentially changes the substance.
Yeah, of the company. So barring those domestic PE and the free zone real estate and everything, either you are fully into 0% committed for it or you are not. At this point of time, we should also highlight one of the slides which I initially skipped. If you become ineligible for the 0% in any year, for the following 4 years, you will be automatically disqualified even if you are satisfying all the conditions. So the moment you become disqualified in 1 year, you get disqualified for 4 years. Not to scare you at almost the midnight, imagine whether you are eligible or not, government has 7 years to check. So suppose they do an audit after 4 years and they say, no, in the year 2024, because of XYZ reasons, you claimed your free zone benefit incorrectly. There would be tax areas and penalty. But even for 25 and 26, which you would have already submitted as a free zone benefit, you will become automatically disqualified, resulting in tax areas and penalties. So when it comes to free zone, please tread it very carefully. At that point of time, perhaps consultants like us would be required to kind of guide you through all your eligibility conditions and take you through that, whether you qualify for a free zone or not.
In these cases, people will move that business to mainland.
They can continue in mainland and pay 9% free zone and pay. Yeah.
With that 90-10 split or whatever 5 million, they would typically move it out to mainland, the one that is 9%, and not hamper the.
But if they split the business and bring it, then there is another concept of anti-abuse rules. So one has to also examine that this entire split of business is artificial or it had some commercial justification to it or not. So that would also be there. Anti-abuse rules is also very important to consider.
Yeah, but then I don't want to give away my benefit just because I had a business that was existing at zero tax before the tax regime came in. And now just because it's coming, I just move that. And probably it's a genuine movement, right?
Fair point, yes. So one has to create that entire documentation around it as to why you are splitting the business and all. I think with this, Cicely would like to start the panel discussion. I can leave that. There were a couple of VAT updates, time permitting, I can cover it later. But just before we start the panel discussion, so this is the QR code. If you just scan it from your mobile camera, you can join our WhatsApp community, and then we keep sending periodic updates on it. It's a community. There is no other member is permitted to message. It's only one-way traffic to give you the tax updates.
Hi, everyone. Let's finish the session with this panel. Where's Anshul? Ah, yeah, he's in the room.
In the meantime, one quick clarification, thanks to the questions asked by gentlemen. When we are talking about individual earning real estate income is not subject to 0%, there is a condition attached to it that the activity of real estate should not require a license under the other regulatory laws. So suppose the real estate investment activity requires a license under any other regulatory law like a commercial business or something, then that income could be subject to corporate tax.
We'll have a panel where we have our board member, our charter member, our CEO and chief bestie, Sanjay Babar, join us. He's an investor. He has his own company, and we'll have conversations about with Pankaj about what the investor dynamic looks like, and we'll also have Anshul. He's our mentee. He's our startup on the rise. I'm going to let them share a little more about what they do. He's a founder in a startup, so we bring in that dynamic as well with Pankaj. So he'll take them through. We'll have Q&As from both sides. So as an investor, what would be the scenarios that you need to navigate, and as a founder, so you have everything in place before. I'll give another mic as well.
So my question is simple. How can I pay the least amount of tax? Plain as least amount of tax. But I will pay tax, but I want to pay the least amount of tax.
Simple as engagers. The taxes, there is no planning opportunity in terms of to say that, if I can use the word unethically, reduce it. Maintain your books properly, calculate your next profit. The planning opportunity comes in terms of wherever there are expenses which company has not been correctly claiming, certain transaction structure because historically UAE never had tax. So there are certain aspects which companies have often ignored. I'll give you a very typical example. Instead of borrowing from the bank, you have invested your own funds in the company, which if you would have given as a loan and the company would have paid interest to an external party, it can pay interest to the owners subject to transfer pricing and then claim the expense deductions on those. So those are the typical issues, like having that macro view of the business from a third person's perspective, that yes, if I compare this vis-a-vis any normal business, these are the additional expenses the company could have incurred.
So increase taxable expenses as much as possible. That's the way it goes.
I think that brings my concern, because I was just discussing with him, as a startup, if you would want to bring your expenses higher, you reduce your profits, and that brings a concern to investor, right? So how do you maintain your books differently for a beta calculation versus tax? Differently as in not fudge them, but obviously from a business perspective, something might mean as an expense, but from a tax perspective, something might not, right? Or the other way around, yeah. Mostly the other way around always, so.
True,
and many would be concerned about that.
Just to take that point further, and it applies to both like mature companies and the startups. Historically, because there has never been a corporate tax, which actually applies to me also, we have never bothered when we are incurring an expense that I am paying out from my personal credit card or it's a business expense or not. So that kind of classification and rigorous document keeping that yes, this is an expense, because I honestly am saying, Many a times I would pay the Etisalat bill of the company through my credit card and then I forget to charge back to the company. That's the discipline we need to first maintain to make sure that the right royally the expenses which belongs to the company, even though I'm the 100% owner, gets properly booked back to the point of robust accounting and the record keeping and everything. From a perspective that something is an expense for the company or not for the company vis-a-vis the tax purposes, yes, it's an absolutely important question and classification. The example we took of a heart surgery, whether it's a business expense or not. While those situations may not come on a day-to-day basis, but yes, any peculiar issue, one can discuss with a tax advisor or a tax consultant, take a firm position. And if the amount or the stakes are high, as we said, take a private clarification from the FTA as well. So those are required.
Well, actually, I don't have many more questions because I asked you all the questions while I was sitting there.
So I'll ask a question.
Yeah,
As
absolutely.
companies or as startups, do you have that kind of a mapping? Do you have that kind of a mapping already done? That who are your connected persons up to 4th degree of kinship, and is your company doing any sort of a business transactions, not just with those relatives directly as individuals, but perhaps by the companies 100% owned by those relatives? So is that kind of a mapping, do you see in the business community being talked about? Are they doing it already? Or are they even aware of this?
Well, I don't think they are. For us, for my organization, I have 2 immediate relatives who work for me. And no, they've been working for us for 20 years, but they're all immediate relatives, which also I asked you while I was sitting there. How to deal with that, I cannot do until I get the benchmarking data from FTA, right? Whilst right now it's business as usual, we continue to pay them whatever we pay them as we have. So it's salary, it's house, it's car, the usual benefit that I would give any other employee, they also get. But until the FTA doesn't come up with more clarifications, although I was hoping it would be there in the transfer pricing, the 150-page document mentioned nothing about this.
Absolutely. But I would like to add, because of course when we present, we only take the bullet points on the slides, and this session was meant only for startups. For a situation like this, when we talk about transfer pricing, the law itself, and when we say the law, the decree law, the cabinet decision, ministerial decision, has a kind of a clause which says that if 2 people are otherwise, like an individual and a connected person or a company is dealing as if like independent person, that's the expression used, as if they are independent person, then the transfer pricing documentation and all does not apply. So as you're saying, you are paying to your relatives just like you are paying to any other employees, and that kind of policy could be established. There is a very good likelihood you don't need to undertake a detailed transfer pricing study.
Probably if you have a salary, the salary established before the law was passed.
Yes, it is. Both of them are working for 20 years plus with us.
You cannot ask you to decrease the salary.
Yeah. So to that extent, there is already a kind of a window room made available that if you can prove that the connected persons are dealing with each other just like independent people, then the transfer pricing regulations, documentation would not apply.
But even me as an owner, I also draw a salary.
That would be covered, yeah.
And I've been drawing a salary for 20 years with all the benefits that come along with it. And it's the same or increase usual over time. But I still don't have a labor contract, which I still have to do. But that means even if I get a labor contract now, my history will not be counted.
So it's an interesting question, and thank you for asking this question, that many business owners, especially the family business owners, are believing that, okay, let us start showing salary in 2022 books which are yet to be finalized for audit, or in 2023, or suppose you have a history. That history itself would support the transfer pricing. Answer is directly no. If we look at the transfer pricing jurisprudence in other countries, history of paying salary in itself does not support that the salary is justified. So it can mean that one might be paying a higher salary to himself or herself for number of years and everything. The benchmarking has to be done for a particular financial year. The only thing the history could possibly help a business owner is to say that, look, this is not an anti-abuse that I am drawing salaries to decrease the profit, but that anti-abuse in itself would not have applied for the simple reason that if I am working for a company, like if I'll give an example, you would not have been working for your company. You would have for sure engaged somebody else to manage the operations, to be the CEO of the company and everything. So it can, whether or not you had a history of paying salary, it cannot take away the fact that you are indeed working for the company and you are entitled for a salary.
But I would never pay a CEO what I pay myself.
That's
for sure.
the benchmarking part. So that's the benchmarking part. So that's what exactly I'm trying to distinguish. The history of having a salary or not would not help in the sense that if I can demonstrate that if I would not have worked myself, I would have had to engage somebody else, that means salary is deserved. That's step number one, that salary is deserved. Comes the second point, how much salary is deserved. That is a benchmarking for which the history would not help. So if the benchmarking says that I'm eligible for 100,000, historically I'm paying myself 200,000, that history would not become a benchmark in itself.
But then the 100,000 I can count towards expenses, and the other 100,000 I can put towards non-taxable
Yes,
expenses.
that kind of structuring can be explored for sure.
In your case, I think that cannot be legally, that is not called a salary that you are throwing.
Till now, yes. No.
It's just ownership dividends essentially, right, that you're paying.
Well, it's recorded as salary, it's expensed as salary, it's been approved by an auditor, and so on and so forth. So that's always going on.
But maybe you can clarify, a salary is considered only when you have like an employment contract, right? So if you don't have an employment contract, then you don't have a salary.
I will make a backdated employment contract right now, but not a labor contract, yeah.
But one can now make the employment contract, let's say starting 2023 or 2024. So of course, as we said, at least as per the FAQs by the Minister of Finance, labor contract would become a necessity. Even then, the quantum of salary still needs to be benchmarked. Just because
That's
a
a
labor
different
contract
discussion,
is,
but
yes. But benchmarking would still be required.
So I think in our case in the startup world, nobody's even talking about corporate tax, not even ESR, UBO, nobody knows anything because nobody's aware this has to be done. So that's the scary part. I mean, I probably always see a few of us just roaming around, nobody's aware. So that's a big thing. But when it comes to salary, that's a big question because we don't pay ourselves. Even if we have, we don't pay because we just don't want the cash flow to be disturbed.
Yeah.
So that brings me to a question now. I started paying myself, like just for the sake of, showing a salary in my personal life, right? On a personal note. But from a profit and loss perspective, now if I would want to make an adjustment to the actual salary I would deserve, that would affect my P&L, right? I might not even have that much for the sake of cash flow. So when you
just book the expense.
Yes, I know. I mean, I know. But yes, I can. I mean, that's what we do anyways. So what I mean to say is, in a way, that the rise in the salary that would be there from 0 to, let's say, an X amount, and now all of a sudden you're paying what you really deserve, that's probably 3X. Would now that become a problem, right? Because what you really deserved, you're not paying, not because you didn't want to, you couldn't afford. So the dynamics in terms of that in the startup world is completely different.
True. If I can answer, and this actually, like as we say, hits the nail on its head. When, as a startup, and especially in the tech sector and all, when we use this expression, what we really deserve, that lies that economic concept that we deserve as the profits of the business that we have created or the idea that I have created, or do I deserve for the work that I'm doing for the company? To the extent that I deserve what I really deserve for the idea which has been successfully executed. Like take for example, I always say, Jeff Bezos, who has created Amazon, his idea has now become successful. does on an annual basis, Jeff Bezos would say, like subject to other activities and threshold, because Amazon might be earning millions and billions of profit, can Jeff Bezos say that for my annual work done, I deserve so much? Or that's actually the profits of the business that you have created, and since you have created, you actually deserves to reap that fruit. So that distinction needs to be made, because when we talk about salaries, and only to the extent individual tax is not there, we are talking about salary, then to that extent, we need to benchmark it for the work done, not for the benefits of the idea that has been created.
No, but my question was slightly different. In fact, if you go with that principle, then in the early days you do more work than in the later days, right? So the whole story flips. My question was on the principle of the fluctuation, where you deserved it from the sense, let's say the market value, okay? Let's say lower than market value, but you still didn't pay yourself. All of a sudden you wish to pay yourself and you started paying yourself. Now because of tax you decided to pay yourself a little bit more. But now that fluctuation, as you said, comes under, I think, anti-bribery law. Oh, sorry, anti-abuse law, right?
Not necessarily.
Not if you cross the benchmark.
Not if you cross the benchmark.
Not if you cross the benchmark, yeah.
Okay.
Yeah. So,
That's the caveat there.
Yeah.
So anti-abuse will apply as a concept whether this should have been done or should not have been done. If it could have been done in terms of paying salary, then what is the benchmark? Then anti-abuse will not apply.
But there is
But-
what you were saying about Jeff Bezos doesn't really apply at the moment because that's a public company, while a startup, I don't think can be considered a public company, right? So
True, but I'm on the concept like when we use as a startup founders, whether as a tax consulting or a tech startup, when we use this expression, what we really deserve. So like when we have created a visibility, when we have created a kind of proven the concept, tested that now there is a ready customer base. So now because the customer base is coming and the revenue of the company is increasing, I deserve that return because of the efforts done in the past, not for the current year efforts that I'm doing as a CEO.
So one question is, if I, sorry.
Sir.
So the question is, if I pay myself 10 million, I am also the owner, but I pay tax on the 10 million, am I still breaking the law?
No, so ideally when on the 10 million as a personal income tax, you're saying 10 million you're drawing as salary.
Yeah.
So the moment suppose a personal tax comes, then the tax arbitrage to draw a salary and increase the company's expenses would automatically go away. So it's right now UAE is peculiar to face that situation because there is a tax on the company but not on the individuals. Himanshu?
Yeah.
People to realise that even if you are in a free zone, that you can elect to take the SBR, which is the mainland one. Because if your projections don't tell you you're going to be over the 3 million, even in a free zone, you can say, okay, well, I don't want to have a free zone because I'm non-qualifying. I'll elect to go over here. Yeah, is that correct?
So even if you're in a free zone and your revenues are less than 3 million, you can opt for a
SBR.
small business relief.
And-
then
and-
in which case, paying out a salary to oneself would not be the bigger concern because
No, I think we will be in the other side of the story, fortunately. So,
Oh, okay, there you go.
so that's why it is something to worry about for a good reason.
It's a
I
good
think.
problem to have.
It's a good problem to have.
What if you're a startup? What if you are a startup that has done some seeding rounds and you get like a major cash infusion, like, I don't know, $5 million? Do you have to pay tax for that cash infusion or not?
No. So the cash infusion which is coming either as by way of a share capital or even by way of a loan, both are not your revenue. So it will not go into your P&L accounting profit, so they are not subject to corporate tax. Just flipping this question from the investor's perspective, when the investors are putting in their monies as individuals and then later on they're earning dividends or a capital gain on exiting, again that would not be subject to corporate tax. For the companies who are doing the seeding, fundings and everything, to the extent they are earning dividends, no tax again. So it kind of creates that environment to do the seeding, funding, venture capitalists. And if you are holding at least 5% of the shareholding through that seeding round, even the capital gains on exiting would not be subject to. For capital gain, yes, but dividend, no limit required. No, above 5%, then capital gain is not. If you own less than 5% and then you are earning capital gain, then that would be taxable if you are a company. If you are an individual, then anyway not taxed.
So now, if you are in a free zone and you have a services company, is there any reason to stay in a free zone, or does it have any advantages?
Like from a tax perspective, no advantage if you are providing services to the mainland customers.
No, if we are not providing services in Dubai, we are providing around the world, but not here.
As such, there is no tax advantage to remain in the free zone the way the tax law has come out. Personally speaking, my personal opinion, free zone in terms of infrastructure facilities may still be better to operate as a service office compared to the mainland. That could be the only differentiating factor. You would know better in terms of the experience.
Yeah, it will probably be more cost effective. But don't they get 0% tax if they're only doing exports?
As a service, if they are doing service exports, 0%
No.
is not eligible.
Wow.
Services would be eligible only if you're providing to other free zone customers.
Within the free zone.
Other free zones also, but free zones.
Free zone zone customers.
So free zone services is zero.
Zero.
Yes.
If that's your 100% business model, services to other free zone customers, whatever be the nature of service,
When
zero.
a service to Europe, it's taxed.
If it is more than 5% of your revenue or 5 million, yes.
Then the whole revenue is taxed or only
Whole
that?
revenue will get taxed. Then you lose the de minimis limit.
You lose the status. You lose the zero status. That's quite unfair. Yeah, that's quite unfair.
It is. But let me ask a question among the audience. Like, how many of us have already registered for corporate tax? If not, what is holding you back from registration?
There's no need.
Yeah.
Not until September 25. That's what some of the other means are practical terms. Why would I?
Okay. But let's flip the question. Why should you not? Like, in any case, it's an eventuality.
Why be in the radar?
We want to get more insights.
Okay.
So I have a question, because I'm at this stage. Why would I register a company in UAE under this current tax law? What is the advantage compared to?
My basic bullet points, I'm not like economist, so to say otherwise. The corporate tax rate of 9% is still much lower than many other countries who will provide you the similar kind of infrastructure, facilities, security. So that way, as a comparative tax jurisdiction, UAE has much more to offer at a 9% corporate tax.
So if I am going to open a company, where should I open a company?
We are not into the company opening.
I have.
Because at the end of the day, there is tax here and there.
Sanjay would have a much better insight.
No, that wasn't. I wasn't answering that. I mean, that's too broad for me. He might be able to. I mean.
Well, it depends on what you're doing, right? So it depends on your business, what your focus is. So there are umpteen questions that we could
Yeah, actually, I do business setup, but now this corporate tax is coming, so I want to know what I should advise.
In 5,
my
I mean, in
clients.
5 is good choice.
Actually, true. Is actually a very good.
I mean, yeah, they supported me a lot, so I would say, yeah, go for them.
So in question to the panel, would you open a company? Now you already have a company.
Yeah.
Would you consider UAE as a good place to open a company, knowing what you know now about the tax law?
I mean,
What you don't know?
so there are a lot of unknowns. I mean, but then looking at the percentage of tax and looking at what's coming up, I'm pretty sure the way UAE is looking forward, right, there's definitely going to be a lot of competitive pricing here. Because eventually, from the very beginning, this was supposed to be in favor of investors, right? And they're definitely going to maintain that. We as startups do not really think of it from that perspective when we started. We were looking at the market because tax and all this can definitely be played in a very different way as we grow. That's a good problem to have, I see, right? So for us, I don't think so that's the main concern as of now. It's been 5 years. I mean, I still wouldn't worry about it.
I mean, to answer this question, at least from a tax advisory perspective, we are in a country where our customers are, our clients are. So because we are addressing the UAE clients, so that's why we are here.
And it gives us a lot of credibility as well when we start paying taxes. A lot of companies, I mean, we work with governments and multinationals. The moment we have taxes and tax IDs, we're looked at in a very different way.
So obviously, if you're addressing UAE as a market, you should have a company here and not somewhere else. But if you want to start a company here that does international trade or whatever.
That's a different topic. I mean,
But it's still beneficial because the tax rate here is the lowest.
Yeah.
Amongst the lowest in the world. So we're still paying 9 points.
Yeah.
Which is relatively not, and even the threshold is very high.
$100,000 is a very high threshold compared to other countries as well, as far as I know.
$1 million.
Sorry?
Almost $1 million.
Almost $1 million?
2 million is
No,
3 million is the SBR for 3 years.
3 years.
Like, suppose one is
3 million dirhams. No, I'm sorry, 375,000 is the threshold. You don't pay tax on the first slab.
And plus, of course, like as they're currently saying, and all the audience, that the credibility of operating from a tax living jurisdiction in terms of receiving payments, making payments, everything will be much easier. Barring the tax planning and everything, like I'm a person who's 6 years old in UAE now. The amount of facility, infrastructure, security, the amount of COVID responsiveness. I feel obliged to pay these kind of taxes, including VAT or corporate tax, because we are getting much more than from the government.
So for me, the question of paying tax is not the main problem. It is this level of unknowns that are still there.
So the level of unknowns are relatively less, I would say. In fact, just to give a relative example, like in India's Supreme Court, only about last week, Indian Supreme Court in one of the judgment on this, there is something called double tax treaties between countries. There is a position which has been like happening for the last 20 years, and Indian Supreme Court has passed a judgment last week, which has turned the position on its head. And now everybody is kind of running around that what they need to do in terms of the advantage or the benefits of double tax. When it comes to UAE corporate tax, the unknowns are fairly limited. It's either the benchmarking of owners' salary. Second would be to the extent of free zone, your distribution business, whether certain areas would be allowed or not. But then there are not much, unlike many other jurisdictions, like I've worked in the UK, in Belfast, in the UK tax law. Or India, of course, like the law itself is so thick because there are so many permutation combinations given. If you do this, so much of deductions, everything. That way they have kept it very simple. Do your accounting profit, calculate your accounting profit. These are just limited adjustments you have to make and pay your taxable profits. And this is the kind of theme which Ministry of Finance has actually mentioned in their explanatory guide, wherein they have said that the law has been intentionally kept simple and permissive. They have used the word permissive, that they would like to permit most of the things. And so that people do not take advantage of it, anti-abuse laws have been brought in place. So that way it's fairly pragmatic and permissive, so to say.
I wouldn't go as far as calling it simple. That's pretty generous.
But that is for us to make it complex so that people come to us.
Okay, so can we talk about some funny tax stories? I know there's case law in the UK about a university student who built a business going and filling cigarettes in vending machines. He just would buy cigarettes and he put vending machines all over the university campus and around, and he made a ton of money and he bought himself a Lamborghini. But he claimed the Lamborghini as a business vehicle because he used it to deliver the cigarettes across. And he lost the case, of course, but...
That would be subject to benchmarking.
No,
Over here, the police has Lamborghinis.
And that's Dubai, right? Not UK.
But you have a precedent, so.
no, it's good that you raised. I'll ask the gentleman. Yeah.
As a small business owner, if you were to go out and buy yourself a Range Rover, for example, is that deductible? If you say it's part of the company, it's a company car?
Indeed. So unlike VAT, wherein the car available for personal use by the owner or by the employees are not allowed for the VAT input credit, when it comes to the business expenses, right now, when it comes to vehicle given to the employees or for use by the employees, there is no restriction on the deductibility of the expenses. The depreciation, the car being like a fixed asset, you will not get 100% expense in the year one. You will, as per your accounting policy, depreciate the car over the number of will be allowed as, yes, will be allowed as credit. The only thing you might not get as expense is the penalty of SALIC or some road fines and penalties. That may not be a, that's not so, yeah, so to that extent, yes. But just coming on the funny stories, a couple of things that I remember is like, especially on this issue of what is business or what is not a business. I'm taking more from a UK perspective. Like, people have a lot of big farms and all. So there was a gentleman who had a big farm, and he used to invite his friends for this shooting of birds, that pigeon shooting or that whatever, like some not actual pigeons, like actual thing. No, the actual living pigeons or living flying birds or anything. And he used to collect a nominal fee just to like kind of take care of the expenses of maintaining the guns and everything, cattle feed and everything. And eventually, and there was no threshold like this 1 million and all. So the matter went to the UK courts that the tax authority said, hey, look, you're conducting a business here. And he's saying, no, it's my free time activity. I'm just bring my friends along. We just kind of contribute to this activity and that's it. The court actually said, no, it's a business because you're doing it on a regular basis. You have defined the parameters of it. You have defined the amount for it. So it is a business. You are conducting a business. So all this nowadays when you play, I'm just saying on a lighter note, when group of friends collect to play badminton and then they pool in money, hire a court for 2 hours, be careful who's doing the business. So. The second interesting scenario, actually, in the context of UAE, which is there, we came across very recently only. We have UAE companies who may be importing the goods as the importer on record. For whatever reasons, they are not showing it as their purchases and everything. Now, because you are the importer on record, there is the government statistic which has been built up that you have imported goods worth say 100 million. But if you do not show that purchase and a corresponding sales, going forward the tax authorities may question you that as per our records you have imported goods worth 100 million, show us what you have done for it. So please make sure that for all your businesses, like there is that macro view always being available as to what different arms or different divisions of your business are doing. And each data is kind of saying the same story to each other. Somebody might be saying, oh, these are not my goods, these are customer goods. Even if these are customer goods, where is that data available? Where is those agreements available? All sort of data points needs to be kept in mind. So I'll just make one thing. The other is, as we said, UAE historically never had tax. even in the context of VAT, certain expenses like food bills and all do not allow us to recover input credit. So as a matter of habit, we don't collect and retain those invoices, those bills. If I'm going out for let's say an exhibition GITEX, I could very well claim it as a business expense. But if I have purchased a GITEX ticket, do I retain that invoice with me or not? Is a change that we'll have to go through as a matter of our processes to keep the invoices and bills, make sure those invoices and bills are in the company's name. There is no threshold which has been prescribed. Those small, minute issues will become debatable or disputable issues with FTA going forward.
So the invoice has to be the company name?
Ideally, yes, because as per the corporate tax law, if it's not a company's expense, we cannot justify that it's not a company expense.
But then how do reimbursements work?
So reimbursement would have some sort of a guidance going forward, but otherwise you might have to instruct all your employees that make sure the company name is written and it was a business expense.
Wow, I didn't think about that.
So that could be the reason. The other typical issue, just sharing insights from what we are doing for our clients, when there are group companies which are available, so and they are part of the VAT group. So as of now, company A, company B, company C, three are part of the VAT group. So nobody bothers that the invoice is in the name of A, B or C, because for VAT you can recover input credit. But for corporate tax, you will have to prepare standalone financials of A, B and C separately. So you have to make sure that company A is booking the invoices which are in the name of A. They cannot book the invoices which are in the name of C or vice versa. So those accounting disciplines, the documentation discipline has to come very strongly now.
Sir, I have two questions. Regarding it's about the van. So in the van, there's two scenarios. I have some employees who's working Saturdays and they're sitting in my office.
You can give the mic.
I'm running my company and my employees are sitting in office for Saturday and I'm providing some food for them. So is it claimable or it's not claimable?
Now, as of now, the food given to the employees should be allowed as an expense, deductible expense.
Okay, so second scenario, I'm just taking them, all of them to the out for a dinner. So is it claimable or not?
As of now, again, yes, should be claimable, that there is no restriction prescribed on that to the extent of employees. Now, if you are hiring them, let me add spice to the discussion. If you are not, they are not on your employment visa, you are hiring them as a freelancer or they belong to some other company's visas, then they will cease to be your employees. Then this entire position of expense deduction could be restricted to 50%.
Okay, so what's the entertainment expenses means? The entertainment expenses are not able to deduct under VAT, right? I mean, we can't able to.
Expenses 50% only, but that's in terms of listing owners, business partners, vendors, customers. Employees are not listed in that, and employees, it has been specifically clarified also in one of the FAQs that the entertainment expense on employees is deductible at 100%. Employees only. Good question. Yeah. No, that should become 50%. Yeah. It's guide mentioned. Okay. Yes.
What about the launch events? Like suppose a real estate company conducts a launch event and they use the expense because it is for the customers. So what about that?
So
maybe in the hotel or in a conference.
Yes. So slightly subjective, and there are like case laws on both sides, judicial decisions on both sides. Launch event could be treated as a marketing and advertisement and should be allowed 100%. But launch event is just an excuse to entertain the customers or the vendors and kind of create the entire reasons, then it could restrict to 50%. So then also, because the nature of the expense will be examined. So if you have hired an external company to a launch event, they will invoice you. That expense could still be treated as an entertainment expense looking at the real substance of that launch.
Okay. So we have, in an example, a company has done well for the year and they want to take their 50 employees to Oman. Fully expensed, hotel, everything else. Deductible, not deductible?
So again, I'm talking about the way the law is worded currently. If the company is taking their 50 employees to Oman for 2 days offsite and all, there is no restriction prescribed currently under the UAE tax laws. Should be allowed for corporate tax purpose. I'm using the word should be allowed 100%. For VAT purposes, to the extent of these personal trips and all, the credit is not allowed. For example, there is a specific mention, iftar parties and all, VAT credit will not be allowed. So,
yeah, but this is an offsite to celebrate, so that will still be treated as personal. Not
Yes.
so if it's a training offsite, then
I was coming. So, like in India, they have found a way in many jurisdictions. You can show a one-day training exercise, and you can say that it was a team-building exercise to claim. That's possible. But so for them, the VAT will end. Yeah. So VAT anyway will not become an issue. VAT is because UAE VAT cannot be taken. But yes, as a business corporate tax, they do claim that expense, that it's a strategy meeting and all. Yes. Oh yeah, Dubai will become a destination. I think with this we can close that. I mean, last question we'll pick up from.
If I have a holding company and then I have 10, 20 operational companies that qualify for small business relief, what is the scenario when I can pass this audit from the tax office without being accused that I split one large business into 20 small businesses?
So once, of course, we'll have to examine in detail, but couple of points which come to my mind right now as you are asking the question, they'll check the history, like for how long these number of companies were operating as such. Like if you've been operating like that for last 10, 15 years, it creates a credible history in that sense. Second, given the nature of operations, whether they are financially dependent on each other. Effectively, it's one business split into many companies, or each company has its own self-existing, self-sustainable business or not. Third, the customer base, are they sharing the same customer base? Or as I'm using the expression, each unit or each company is a self-sustained business having its own vendors and customers. Those are the couple of criteria that tax authorities would examine, or you can examine proactively to decide whether you should claim SBR or not. Great. Thank you once again. Thank you both to Sanjay and Anshul for being the panel members. And thank you. Over to you, Cicely.
Thank you, everybody, for staying for so long, and hope it was valuable. You know who to connect to for tax reasons and for anything related to entrepreneurship. We are here. Thank you, and have a good evening. Drive back safe. There's thunder, lightning, showers in different places of Dubai. I'm not sure what's happening outside though. But DIFC, Al Nada, they're all chock-a-block is what I heard. Have a good night.
Thank you so much.